A focus on the consumer, a focus on the Fed, and sadly, a focus still on Washington. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. Actually, we're looking at a second day of gains on the S&P 500. That benchmark currently up about 0.5% or so. Big tech leading the way. The NASDAQ 100 up by about 0.8%. It probably helps that things are cooling down a little bit in the bond market, at least for now. You look at 10-year yields, only up about 2 basis points or so, but we're looking at a very high level, of course, 4.62%. Again, near 15-year highs. And I did want to take a look at the dollar because you're not seeing that haven rush that maybe we were seeing towards the start of the week. The Bloomberg Dollar Index currently off by about 0.3%, Romaine.
Yeah, absolutely here. And investors are really still out there looking for some sort of read on the economy, and they're going to get a couple of key data points over the next 18 hours or so. After the bell tonight, not official data, but we are going to get earnings out of Nike, the shoemaker among the 50 worst performers in the S&P this year. And here's why. A slowdown in sales growth that is expected to have extended for a third period on a quarter-to-quarter basis. And the concern for investors, it goes way beyond Nike alone. A key index of consumer durables and apparel companies among the worst performers among the 24 S&P groups and underperforming the broader market by at least 12 percentage points. Rising borrowing costs and still elevated inflation right now really sapping consumer demand for anything discretionary out there. And in fact, that trend actually is showing up in the official data. The latest revisions of second quarter personal consumption is out, and with U.S. consumer spending advancing at only half the pace as previously reported. Now, we're going to get more up-to-date figures tomorrow morning when the Bureau of Economic Analysis releases monthly consumption numbers for August. But those numbers are expected to show the pace of growth slowing for a second straight month to 0.5% growth. But when you adjust that for inflation, so-called real spending, economists expect that number to be zero, squadouche, no growth at all. It'll be interesting to see how the Fed interprets this trend. A conversation in the 3 p.m. hour right here on Bloomberg The Close with Richmond Fed President Tom Barkin. And in just a few minutes from now, we're going to have an interview with former Vice President Mike Pence following last night's Republican Party debate where 7 presidential hopefuls got on stage and spent a lot of time talking nonsense rather than delivering any substance, Katie, about how to address the government shutdown that the market is mostly focused on.
And we are barreling towards that deadline for a potential government shutdown, of course, coming on Saturday. And with that in mind, I thought it'd be helpful to take a look at how the stock market has performed over past shutdowns. And of course, one of these lines really stands out. It's our longest government shutdown, and it's our most recent one, December 2018. Actually, the S&P 500 rallied about 8% over the length of those 35 days. So not too bad, but of course, the environment is starkly different this time around. Of course, back in December 2018, you had a Fed leaning dovish, and that obviously helped out the stock market. You take a look at where we are now year to date on the stock market and where we are in terms of some of the sectors that could be most affected. As you can see, the overall benchmark in orange here, we're still up year to date, but you can see that line has been trending lower, of course, in light of that hawkish Fed. And then you take a look at aerospace and defense, you take a look at healthcare. Both of those sectors lower on the year. Of course, that has to do with many different factors, Romaine, but imagine we do get a shutdown, obviously wouldn't be helpful for some of those government contractors.
Yeah, absolutely, Katie. Let's get some insights out of our first guest here, Stuart Kaiser, Citi's head of U.S. equity trading strategy, joining us right now to talk a little bit more about this. And I do want to start, Stuart, with kind of the elephant in the room, which is the potential for a government shutdown and the potential for an increase in volatility in markets should we get to that September 30th, October 1st deadline and nothing is done.
Yeah, good to talk to you, Romaine. Look, I think, from our perspective, the government shutdown so far is actually not being priced, too aggressively from a risk perspective. The stocks that we track that have a lot of exposure to government spending have not seen, their implied volatility rise particularly. We haven't seen them sell off from a price perspective. So at this point, it doesn't seem like the market is too concerned about the shutdown or thinks it's going to be, relatively short in duration. I think that's the good news of it. The bad news would be if it, turns out to be worse than that, then the market doesn't seem too prepared for it either.
They also didn't really seem too prepared, at least as of late, Stuart, with the sort of resurgence in yields that we've seen over the past couple of weeks here. Obviously, everyone wants to know kind of where that top is. But I think the more important question is how do you sort of, I guess, invest around that? If this is sort of the new reality, the new normal, what is the trade? What is the investment?
Yeah, look, I agree with you, Romaine. I mean, it has caught people by surprise a bit. I think the Fed was a little surprising, kind of taking 50 basis points of cuts out of 24 instead of 25 basis points like the market expected. That kind of reintroduced bond volatility back into the system. So I think as much as the level of rates has played a role, I think also the volatility of it has. Our view is big picture. You saw it in jobless claims today. The U.S. economy remains strong. Labor and services side of the economy remains strong. So I think with that as a backdrop, your core view has to be generally positive on equities. But, going into quarter end with a lot of rates volatility and then some uncertainty from the government, I think that has people definitely cautious and hedging. So, our view would be, be careful here for the next call it a week or so, but then ultimately it's going to be the underlying pace of economic data that determines the path the market's going forward, and frankly also, determines the path of the Fed. So those things are pretty closely linked to each other.
Well, if you're seeing bond volatility really translate into the stock market right now, and then you consider that we could be heading into a potential government shutdown, where within the stock market should that show up?
Yeah, I think, Katie, it hits it in two places. One is what you've already touched on, which is, companies with direct revenue exposure to the government. And the second would be, the more rate sensitive parts of the market. Obviously, infotech is a big component of that, generally very sensitive to rising yields and yield volatility. That part of the market has also been volatile recently. There's some other, cyclical parts of the economy you might want to focus on. But I think investors' focus right now is on those two aspects, the companies that are most directly impacted, and then the stocks that historically have responded the most negatively to higher rates would be tech, semiconductors, things of that nature. So I think, that's our focus. That's where the clients are focused right now as well.
And let's talk a little bit more about tech, because the story around tech has become a little bit confused, a little bit tortured, because you can make the case that, okay, higher rates, that should slam tech. They have those long duration cash flows that should be sensitive to higher rates. But then we've had plenty of people come on the program and make the case that, okay, some of these tech companies that we're talking about, they have mounds and mounds of cash. They're going to be fine no matter where interest rates are. How are you thinking about tech in this environment?
Yeah, look, I think that's a fair point. Our U.S. equity strategies have made that point as well. Large cap tech with all the cash on balance sheet actually, does pretty well from a net income perspective when this is going on. And I think you broke it down, though. There's two aspects to this. There's more the fundamental side of the equation. And I think that equation, frankly, that side of the equation is much more positive today. Microsoft of 2023 is not Microsoft of 1995, right? These are mega cap stocks with huge free cash flow, very strong balance sheets, et cetera. So I think the fundamental impact of higher rates right now should be less, at least on the mega cap part of the market. It's the smaller cap, profitless tech type stuff where I think you really need to be careful from a fundamental aspect. But the price response part, if you look at that, is tech is still, at least in the last month or so, has been responding negatively to higher yields. So again, I think that just reintroduces this idea that you need to be tactically cautious if bond volatility is high. But if you get back to the fundamental story, those mega cap techs should actually be pretty okay in a higher yield environment once those yields stabilize.
Well, that gets to the point, too, I guess, of the rotation that we're seeing around the equity market here. Tech, of course, was the big story, at least in terms of return in the first half of the year. The Russell 2000, at least as of the last few days and last couple of weeks, has started to perk up. And you're starting to see meaningful outperformance now in small caps and some of those cyclical names versus those big cap tech names.
Yeah, that's definitely happened underneath the surface. Russell 2000 is interesting. It's been such a big underperformer. I think a lot of investors have been generally kind of short those stocks because they're highly sensitive to credit spreads, rates, and economic growth. So I think there's a little bit of debate of, is that move higher, people actually getting more positive on the space, or is there just a little bit of short covering because of the volatility that's going on? But look, it's certainly a discussion, going into year end. Does the, let's call it, momentum trade continue and large cap tech continues to perform well, or do we kind of see a rotation into cyclicals? Our view is that rotation into cyclicals is probably more of a 2024 story, just in the sense that you still do have some potential for recession next year. So I don't know that long-only investors are going to be piling into cyclicals ahead of that. And secondly, it tends to be a momentum that works later in the year. So I agree with you. It's, that story is ongoing. The Fed upgraded their growth forecast, so that's going to help as well. But our view is, the move into cyclicals is probably going to be relatively modest back half of 23, but in 24 we may be talking about that a little more frequently.
But even as you get into 2024, if there is sort of a compelling case to be made for that trade, of course, the elephant in the room still remains rates. And if you believe the Fed, and they're sort of higher for longer, whatever you want to call it here, do you think, is there any real historic parallel to show that you would get a meaningful rotation into something like a cyclical trade when you still have rates at cycle highs?
Yeah, I agree with you. I mean, the high level of rates is an issue, but again, I think if those rates stabilize and you did, see a meaningful sort of improvement in the more cyclical parts of the economy, maybe China perks up, that small cap trade, can of course work. But look, to your point, the higher for longer, the refinance issue is a big issue. The good news, I think, for that sort of debt wave or the refi wave doesn't probably hit for a couple of years for most stocks. So there may be a pocket of time in early 24 where the growth data looks strong, rates have stabilized, and people take a shot rotating into cyclicals. But I agree, and I think what you've described is why small cap has lagged this year. You have a real refi risk out there, you have higher yields, and you have concerns about a growth slowdown, and that's just a bad macro environment for owning small cap cyclicals.
Well, let's talk about that a little bit more and the refinance risk that exists for those small cap names. In addition to that, we were just talking about how some of the big tech names are actually benefiting in some ways from the higher interest rate environment. They're actually making interest income. I imagine that doesn't quite exist for some of those small cap companies.
Yeah, I think that would be our view, Katie, is, large cap within the tech space or within the growth space, the mega cap techs are a little bit of their own special breed. And then once you get down the cap structure and once you get down to companies that aren't generating, a ton of, current earnings and throwing off a ton of current cash flow, those should be the ones that are more exposed to the higher yields. And frankly, that's what you've seen year to date, right? Equal weight NASDAQ, equal weight S&P have materially underperformed their larger cap peers. How that resolves itself, I think ultimately it's, are we comfortable that the Fed is at terminal, and do we have a clearer view of what they're going to do in terms of bringing down yields? And then you have the last bit of what would motivate them to bring down yields. That might actually need to be a slowing growth profile. And a slowing growth profile, at least initially for us, is not a time you want to be buying cyclicals. You want to wait for that slowing to kind of play out a little bit. So it's a really tough nut to crack right now, I think, for that smaller cap kind of value trade, and that's why we've been so patient about recommending people get into it.
All right, Stuart, always great insights. Stuart Kaiser there, head of U.S. equity trading strategy over at Citi, helping us kick off to the close here on this Thursday afternoon. When we come back after the break, a sit down with the former Vice President of the United States, Mike Pence, now vying for the Republican nomination for the 2024 election, running against his boss. And of course, we want to get some insights into what he thinks here about policy going forward.
Plus, we'll have an exclusive interview with Richmond Fed President Tom Barkin and get his insight on the Fed's potential next move and which numbers he's paying the most attention to.
And from boxing to businessman, we're going to talk with legendary boxer Oscar De La Hoya about his drive to build the sport's next generation of superstars. All that and more coming up in just a bit. This is Bloomberg. The Republican Party here in the U.S. last night held their second presidential debate. Mike Pence, the former vice president, was on stage. He joins us now.
Trump's counter program.
Not sure that got a lot of attention. I'm not sure Donald Trump's did either. I think it's going to take a minute for us to realize if this strategy is actually working. Does he actually show up at any of these?
I think he would have to show up at a presidential if he does become, in fact, the nominee. I think he's pretty much said there's no point. There's no point of him showing up. Why would he need to do that?
Yeah, absolutely right. Well, I'll tell you what. I'm glad that you're both here because we've got an important conversation. I want to welcome everyone, our TV and radio audiences worldwide, for a special conversation with the former Vice President Mike Pence. I'm Joe Matthew in Washington here on Bloomberg alongside Anne-Marie Hordern. And Anne-Marie, we're just hours off of the Republican debate, as we've been discussing in Simi Valley last evening. That was a debate that could end up being critical for the future of any campaign, including Mike Pence's.
Yep, that's absolutely right. The former vice president was at that debate, and we'll see what comes next for him, right? There's a few people who are saying potentially with his poll numbers, he might have to drop out. That's
right. Well, he joins us from California now. Mr. Vice President, it's great to have you back on Bloomberg. We welcome you, and I wonder your thoughts about that exercise last night. We were just playing clips of 3-4 people talking over each other for minutes on end, a lot of zingers, a lot of one-liners. One of the moderators even wanted to play a game of Survivor with you. I just wonder, to the extent that Ronald Reagan's legacy was invoked last evening in Simi Valley, did Republicans live up to the standard set by Ronald Reagan in that exercise last night?
Well, I'm standing here at the Reagan Library still, and, you know, it was very special for me to be a part of the debate last night and here, because Ronald Reagan is the reason I became a Republican, and it was his conservative agenda, it was his optimism, and it was his civility that really defined the man and defined his administration. And last night's debate was at times chaotic. But I really welcome the opportunity to make my case that I believe that while the former president and some others who were on that stage are steering our party away from Ronald Reagan's agenda of American leadership in the world, fiscal responsibility, even the right to life, that I'm the most consistent and tested conservative in this field. The opportunity to make that case here at the Reagan Library to the American people was a great privilege for me.
Mr. Vice President, you spoke a lot about what you're speaking about now, the fact that populism has taken control of the Republican Party. But if you look back to what Trump was saying in 2015 when he announced his campaign to become president, it reeked of populism. He was calling politicians dumb in his first speech. He was talking about draining the swamp. He was talking about the United States not beating anyone ever. He said, when was the last time we beat Japan? Do you feel responsible for giving credibility to populism in this Republican Party that we're seeing today?
You know, when Donald Trump came down that escalator, he told the American people he was going to make America great again. The first person to say make America great again was Ronald Reagan. And in that campaign, whether it was a commitment to conservatives on our courts, a commitment to cut taxes, a commitment to rebuild our military, Donald Trump promised to govern as a conservative, and I believe when he chose me to be his running mate, there was evidence of his seriousness about that. And for 4 years, we did govern as conservatives. We kept our word. On the world stage, we stood with our allies. We stood up to our enemies. We advanced the largest tax cuts in American history, and of course appointed conservatives to our courts at every level, including 3 of the justices that gave us a new beginning for life. But what I want people to understand is that Donald Trump makes no such promise today. Whatever his rhetoric was back in the day, and his rhetoric has remained the same, the policies that he's advancing now, which include a 10% tax on all imports into the United States that the Tax Foundation said would cost 500,000 jobs, is directly opposite of our administration and the Reagan legacy of cutting taxes for individuals and businesses. The way the president is joining a chorus in the party of embracing appeasement and isolationism and from supporting Ukraine in their battle against the unconscionable Russian invasion, that's not consistent with the way that we stood strong with our allies. We stood up to our enemies, turned our armed forces loose to take down ISIS. We actually, armed forces of the United States, took out 100 Wagner Group Russian military personnel in 2018 in Syria. We stood strong on the world stage, embraced our role as leader of the free world. Of course, lastly, just on the right to life, just in recent days, the American people have heard the president literally criticize states that enacted strong pro-life protections from the moment that an unborn child experiences a heartbeat, and he's made no commitment to support protections for the unborn at the national level. That coming from the leader of the most pro-life administration in history. That's what I mean when I talk about the president and some of his imitators walking away from that timeless conservative agenda. But if I'm president of the United States, the American people can be confident. I'll lead as America on the world stage, being the leader of the free world. We'll lead pro-growth policies, and we'll balance our budget and stand for life.
Your former running mate was, of course, not there last night, and some believe that he will win the Republican nomination without answering a single question in a forum like the one that you endured last evening. What should Donald Trump answer to? Would it be the trillions in debt that he added to the nation and left behind? Would it be his legal challenges right now? What is it?
Well, look, I think he ought to be there. He should have been there last night. He should have been there at the first debate. Look, no one is entitled to the nomination of their party. And frankly, Donald Trump continues to campaign as though he were the incumbent president. But think about this. He's campaigning as an incumbent, but he has less than 50% support of Republicans. That means half of Republicans are looking somewhere else. I think he owes it to our party to step forward and answer the questions. And they can be on those issues. But for my part, I think the president ought to explain, while having passed the largest tax cuts and tax reform in history, he now advocates what would be the largest proposal of tariffs, a 10% tariff on all imports, literally since the Herbert Hoover administration. And why the president, after we rebuild our military, stood strong on the world stage, is now joining a chorus of isolationists in the party, saying that support for the Ukrainian military is not sustainable, and joining others who were on that stage last night who would be fully prepared just to let Vladimir Putin overrun Ukraine. And, of course, as I said last night, I think if Putin grabs Ukraine, that just gives a green light to Xi Jinping to move against Taiwan. So I think we achieve peace through strength, and I think the president ought to be willing to step up and explain why he's changed his mind about America's obligations about leader of the free world, and why he's changed his mind on such a fundamental issue as taxation.
Well, you've talked a lot about your commitment to strong defense. We had on Senator Tommy Tuberville on this week, who said this. This was his quote. He said, "The U.S. military is not an equal opportunity employer. You are the father, you are the stepfather of men who have given their lives to this country, to our military." What does this have to say about the state of the Republican Party?
Well, I don't know the context of that remark. I think the armed forces of the United States throughout our history, from the founding of the country, have been an incredible meeting ground for people of every race and every background who've put on the uniform and served our country.
Mr. Vice President, I feel like we should put a finer point on that. We were asking him about his decision to vote against C.Q. Brown, the new chairman of the Joint Chiefs. He called him woke and said he wants to mix race into the military, and made that comment that Anne Marie just referred to. Is that the wrong view for this country?
Well, look, I believe, and I have great respect for General Brown, but I'm very frustrated when I see the political correctness and the woke politics that's taken hold at the Pentagon under the Biden administration. But I do know how it works. I've worked in a White House. I know how Pentagon works. I mean, we have civilian control of the military. I'm confident that this woke politics is emanating out of the Biden administration. But look, that Senator Tuberville has every right to vote to confirm or not to confirm. But for my part, I've made it very clear that if I'm president of the United States, we're going to build a military fitted to the widening challenges of the 21st century. We're going to get this woke politics out of the Pentagon on day one. And that includes, we're going to reinstitute the ban on transgender personnel in the United States military. I truly do believe that is not in the interest of having a military that is that reflects unit cohesion, preparedness, is deployable. We'll put that common sense back into effect.
Vice President Mike Pence, thank you so much for joining us. That's all the time we have today. Thank you again. We hope you come back soon.
Our thanks there to Anne-Marie Hordern and Joe Matthew, the co-hosts of Bloomberg's Balance of Power. Sit down there with the former Vice President Mike Pence. And we should point out here, Katie, of course, there was a big debate yesterday. Second debate as the Republican Party tries to figure out who its nominee is going to be. But, of course, as they mentioned there, the person who is leading in the polls by a fantastic margin, Donald Trump, of course, was not on that stage. Last time I checked, he's polling at more than 50% amongst his party. Last time I checked, Mike Pence is polling below 5%.
Yeah, and reading the commentary and looking at the polling in the response to that debate, it doesn't feel as if a clear runner-up emerged from the performance that we saw last night necessarily.
Yeah, and I think if you ask the former president, Donald Trump, I don't think he cares two bits about the runner-up, because in his world, he's number one, number two, number three, and all else. Of course, our thanks to the Balance of Power team there for a great interview there with the former vice president. We're going to get back to markets here on a day where markets trying to claw back some of the losses that they had from earlier this week. A pretty strong showing right now with the S&P 500 up about 0.7%. The outperformers on the day in the cyclical and small cap space, Dow Transport's up more than 1%. This is Bloomberg. This is the countdown to the close. Another wild day in equity markets, another wild day in the Treasury space. Let's check in on what's going on in commodities with Abigail Doolittle, who's standing by with our commodities close.
Well, commodities are a little bit calmer, Romaine, but we do have some mixed action beneath the surface. The Bloomberg Commodity Index, similar to stock indexes, overall is a little bit higher. And of course, the Bloomberg Dollar Index is down, so that helping out. But you can see New York crude oil after yesterday's big rally, in fact, a two-day rally, down 2.2%. And some are saying that this may have to do with the idea that the Saudis may ease some of their oil cuts sooner than expected, that they've achieved close to Brent crude near $100 per barrel, and that they may take their foot off the brake soon. Coffee down 1.4%. This is the Real slides. And Brazil gets rain. Apparently that is not good for that coffee crop down there. Gas futures here in the U.S., though, up 1.6%. Copper up 2%, Dr. Copper. So I don't know whether or not that's a read on the global economy, the strength of it, Romaine, or it could just be that Bloomberg Dollar Index being down.
All right, our thanks there to Abigail Doolittle. A quick check of what's going on in the markets. Let's turn now to the business of sports, because that took center stage at the Latitude Conference down in Miami earlier today. Among the speakers was Oscar De La Hoya, Olympic gold medalist, 10-time world boxing champion, and Grammy-nominated singer. Of course, it's been a long time since he's been in the ring, and since then, he's transitioned from boxing to the business of boxing and the business of sports. He's now chairman and CEO of Golden Boy Promotions, which aims to build the sport's next generation of superstars. Pleased to say Oscar De La Hoya joins us right now from Miami. Great to have you here on the program, champ. And let's start off
Thank you.
here.
Thank you for having me.
Absolutely. Let's start off here with some of the moves that you've made as a businessman, particularly in boxing and I guess fighting overall, as of course you're involved in MMA and some of the other combat sports here. Why did you decide to make that transition?
Well, boxing for me has been a long, hard road. Ever since I was 6 years old, I stepped inside the ring. I've had over 200 and some odd amateur fights, 40 professional fights. I was getting a little tired, so I was thinking about what am I going to do after boxing, life after boxing. So I decided, why not become a promoter? Become a promoter. I'm signed with HBO at the time. Why not leverage HBO and start Golden Boy Promotions? We created a boxing series, a platform for young kids, basically, to give them an opportunity, and it just escalated from there. We were able to figure out how to build superstars and how to build pay-per-view stars in the meantime.
Well, we'll talk a little bit more about that. I mean, you came of an era where, I mean, well, really anyone in boxing, I mean, you kind of have to be a personality, right? I mean, it's not just being good in the ring, but you have to be able to sell the fight. You were great at that. Obviously, you have some greats like Muhammad Ali and a few others that came before you here. But a lot has changed also since you've left the ring, just in the way that we as consumers, as sports fans, watch some of these fights and kind of who we follow is not necessarily through the same mechanisms that you came of age in back in the early and mid-90s.
Sure, exactly. And in boxing, it's like telling a movie. It's like telling a story to the consumer, where you need a villain and you need a good guy. And a perfect example, and this was brilliant by one of arguably the best fighters on the planet, Floyd Mayweather Jr. When I fought him, he was known as the Pretty Boy, Floyd Mayweather, making decent money. But after the world watched us on HBO 24/7, where he became the villain and he was playing a character, he was playing a story, and I was the good guy, the golden boy. Well, guess what? It all came together, and that night we were able to break records, 2.4 million homes on pay-per-view, unheard of. But it was the marketing genius of Floyd Mayweather that created that big buzz and that big hype from that night.
And for those viewers who aren't old enough to remember, I mean, that was a big deal back then when they basically kind of a documentary, kind of think, kind of what they do with football now, and they follow the teams. And it really wrapped a lot of people. When you're dealing with new fighters, younger fighters coming into the business right now here, do you advise them to take a similar route?
Sure, I advise them to take a similar route, but obviously you have to now be your authentic self. You know, social media today has changed the game forever. I have a fighter now by the name of Ryan Garcia who just fought Tank Davis, which sold about 1.3 4 million homes on pay-per-view. And again, it was the villain against the good guy. But this time it's now all on social media. There's a story they're telling through their platforms. They're connecting with their audience, a much younger audience. And so we were able to adapt in a way where we never thought we would, because, you know, boxing has always been old school, traditional. You know, you gather the families at one home, everybody chips in their $5 to buy the pay-per-view. But now the consumer's watching on their phone, they're watching on their tablet, and they're watching it alone. So now we're just creating enormous numbers for the sport of boxing on pay-per-view.
Well, Oscar, to that point that social media has changed boxing, that's true of many sports. What about name, image, and likeness deals? Has that changed boxing and the business of boxing, if at all?
Absolutely. It's obviously enhanced it dramatically. When you're promoting products on a national level, and you can leverage that into your sport, into boxing, into your fight, it's a win-win for everybody. So now, I mean, social media has changed the sport and any sport drastically in a way that we just never thought of, especially boxing, because it's so individual and every fighter has their own individual brand.
I am curious here, Oscar. This is when I indulge sort of my own sort of sports fandom here. I mean, you mentioned, of course, the Mayweather fight. I am curious, of all the fighters that you went up against, whether you beat them or you lost, whether it's, you know, the Mayweathers or Felix Trinidad's or Chavez. I mean, who was like the guy that I think when you walked out of that ring, you felt like, okay, this is my match. This is basically my equal.
I think it had to be. I fought Manny Pacquiao in my last fight of my career. I was on the decline at the moment, and he was in the incline. He was the Manny Pacquiao, the superstar coming up. And when I faced him, I was overmatched. I was not myself. I was just getting a little older. There was a transition happening. You can see it inside the ring, round after round, where Manny Pacquiao was becoming the superstar. That's the one fight where I said to myself, my gosh, this kid here is going to be a superstar.
All right, I'm going to have to leave it there. Oscar, really great to catch up with you. Oscar De La Hoya there, of course, a legendary boxer, and now he's the chairman and CEO over at Golden Boy Promotions. Katie Greifeld, are you a boxing fan?
I do watch fights sometimes when there's big fights, obviously.
On the street or like on TV? Because this is New York City, so who knows
every day in New York.
About.
But no, when there's a big fight on pay-per-view, of course, I'll probably watch.
I mean, I'm always fascinated by some of these guys because you kind of forget there was like a period where these athletes, their only income really came from the sport itself, right? And maybe they would get on a Wheaties box or something, but it's just changed so much now. I mean, these athletes come in from day one, they're already thinking about other business ventures and ways they can leverage their popularity to do something else.
And I mean, to Oscar's point, social media is game-changing. I follow track and field very closely, for example. They're not paid exactly like football stars. So social media, some of the promotions you can get and the brand deals, it's really important.
What's the documentary on like a long-distance runner?
They need to.
Is that going to be exciting? They need more trash talk in track and field.
Maybe I know. We need like a Drive to Survive sort of documentary. I hope someone's making that. But in any case, still ahead on the close.
You're still young, Katie. You can make it yourself.
That's true. Something to consider. But we got to talk about Nike first, because Nike reports first quarter earnings after the bell. We're going to talk to the analyst that recently lowered his rating on the sports apparel giant. That conversation coming up next. This is Bloomberg.
Let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Redfin. D.A. Davidson analyst Tom White says the company right now is wrestling with an identity crisis as it drifts further from its core real estate business. White says a full transition to digital media and advertising could create some value over the next 12 months. And based on that, he lifts his rating to neutral. Shares fractionally higher on the day. Next up, let's take a look at NextEra Energy, a downgrade to perform over at Oppenheimer. Oppenheimer saying that the renewable energy company and the decision that it made to cut its dividend and growth outlook, that was a move that was a little bit too reactive to the current market's environment. Those shares down 17% here on the day. And finally, interesting call here on Oshkosh, the trucking company, going down to sector weight from overweight over a key bank. The analyst admitting that this call may appear, in his words, controversial, but he's standing by it, saying there is a need for a more cautious approach right now, given what he says is elevated backlogs and more moderate order rates. Shares of Oshkosh only down fractionally on the day. And those are some of our top calls. We do want to stay in the sell side space here and take a closer look at Nike. Growth challenges in China and choppy U.S. consumer trends, some of the factors putting pressure on the footwear maker. Investors, of course, also going to be watching those inventory levels and how for when the company reports after the bell later tonight. Let's get some insights out of Randal Konik. He's equity analyst over at Jefferies. He has a hold rating on Nike. And Randal, let's start off here with the revenue trend, because we've seen some softness over the last couple of quarters. And based on, I think, what we have on the Bloomberg terminal, we're expecting that trend to have continued in the most recent quarter. Is that softness specific to Nike, or is that something broader in the apparel and footwear space?
I think it's both, actually. So from a broader consumer perspective, we're seeing the consumer become more volatile. The consumer's becoming a little bit more cautious. The consumer's also becoming a little more price sensitive. We're seeing trade down happen across multiple product categories. That's the broader consumer kind of read right now. As it relates to Nike in particular, we are starting to see a little bit of evidence of some market share losses at the fringe, not overall, but from a running perspective. I think it's pretty clear there are some other brands out there, or many other brands out there, that are impacting the running space. Come to mind, names that come to mind of late are obviously the market understands of Hoya and On Running, et cetera. But I think those are some of the items to watch out for from a Nike specific perspective on competition, but also it's a broader kind of, I guess, a caution on the consumer is our view.
I am curious as to how we should view Nike. I mean, they obviously have a very wide range of products in terms of price points. I mean, do you put them more as kind of a discretionary, luxury discretionary, or is it maybe just a little bit stepped down from that? I guess my question is that if we are headed towards some economic down times here, how much does that affect a company and a brand like Nike?
Yeah, look, we all need our Nikes. That's more of a need, right? We go to school, everyone has Nikes. The question, though, from here is can everybody afford their Nikes? So the one thing that I think about with Nike, it's a ubiquitous brand, just like Coca-Cola. It's everywhere. It's for everyone. And price point architecture, if you think of their price points, anywhere from $30 or $40 at the low end to over $200-300 at the high end. With gasoline prices up, from oil prices being up, with student loans about to be repaid, there's a lot of pressures coming to the consumer ahead, especially impacting those with lower disposable income or lower incomes. And that's where we see a little bit of caution for Nike going forward. It's more that lower end price point, that lower end product that could be impacting the company going forward.
Well, Randal, which region do you think warrants more caution right now? Is it the U.S. consumer or is it China?
Look, I think with China was actually pretty good last quarter in the fiscal fourth quarter. We expect it to be okay in the fiscal first quarter reported after the close. But with China, what's interesting from my vantage point is the volatility in that region. It's pretty much all over the place. So that causes some concern from a visibility standpoint. The other thing that's happened in China is that you've seen some of the local brands gain some market share at the expense of the import brands around the world like Nike. That's something to watch going forward. And then lastly, as it relates back to the U.S., I think that's where the bigger concern is for me personally. As you see, the consumer is starting to get more pressured, and Nike's business in the U.S. is starting to show a little bit of cracks here and there. So that's where we have more concerns. It's more about risks of business in the United States, and then just more of a lack of visibility due to volatility in China.
All right, Randal, really appreciate you jumping on for us today here. I'll push ahead to Nike earnings after the bell. Randal Konik there over at Jefferies. We should point out, basically, we are going to get those results after the bell, and the expectations, again, slightly to the downside in terms of the revenue growth trajectory. We'll be back in a moment with more. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment with the host of Wall Street Week, David Weston, who joins us every day at this time. And David, I think today we're going to be talking a little bit about venture capital and specifically a big company out there in Israel.
Yeah, in the Middle East, something a little different here. We've heard these stories that maybe a deal with Saudi Arabia and Israel and the United States. And so we went to really one of the leaders in venture capital over in Israel. He's Jon Medved, founder and CEO of OurCrowd, and said, if in fact this went forward, how big a deal would it be for that region and for his business?
It's an incredibly historic manifestation of the promise that was really unleashed with the beginning of the Abraham Accords. As soon as we made peace with the first four, the thought I had was that this was something akin to the dropping of the Iron Curtain, literally as important. I called it the Sand Curtain, and predicted that this was obviously going to open up and include sooner rather than later the Saudis. And I've been traveling back and forth to the kingdom. I'm very impressed by what's going on there in terms of the development of venture capital culture, both as investors, but more importantly, as startup people and creating technology. And once this goes all the way, and I think you have to listen to the Crown Prince when he says that we're getting closer to this normalization day by day. And in fact, this week we're seeing an Israeli minister openly being recognized and celebrated in Riyadh at a tourism conference, with two other ministers now scheduled to go, a Saudi representative visiting openly Israel and the West Bank. We're getting there, and this is really going to change everything.
Assuming this all goes forward, as we hope it does, are there particular sectors that are high up on the shopping list, as it were? Is it AI? Because certainly here in the United States, all we hear about is venture capital going into AI, artificial intelligence. Is it cybersecurity? What are the areas that are ripe for investment and joint venture?
Well, those are two really good ones to start with. AI is everything. For example, at OurCrowd, we're invested in 81 different AI companies, where we've just launched an AI fund. And if you look at, that's the one brightest area of venture capital investing, where people are investing not just in, open AI and ChatGPT, but Anthropic and other companies. We have a company called Halo. We're making sort of edge accelerators like an NVIDIA series accelerator, but much cheaper and smaller. So that's going to clearly be a focus for the Saudis. They believe in it. But cybersecurity is obviously front and center. Israel is a world center for this. 40 cents of every dollar invested in cybersecurity globally is invested in Israel. So I expect there'll be cooperation in that area, but it goes way beyond. And that's one of the neat things about how broad this is. I think there'll be smart cities, especially when you look at what the Saudis are doing in Neom on the Red Sea coast, where they're building this incredible project of hundreds of billions of dollars, where it's probably going to be one of the most advanced infrastructures anywhere, and great technology there, technology and mobility. We're already co-invested with with Saudi family offices in mobility companies. And by the way, you should not neglect the fact that the Saudis are not just sovereign wealth investors, but also tremendous individual and family office and other institutional investors there as well. It will be in food security, in agriculture, in climate, in renewable energy, which obviously is high on the Saudi list. So it's almost financial technology, fintech. It's hard to find an area that Israel and the Saudis, I think, will not cooperate in.
This possibility has come about in part because of a shift in policy of the Biden administration. President Biden came in, was not very friendly to Saudi Arabia. There's been a shift. And for those of us in the United States, it's looked in part because China has come in. And there's a little bit of a competition, it feels like right now, between China and the United States. Do you expect that in Saudi Arabia, that there will be an ongoing competition between China on the one hand and the United States on the other?
Look, I think we're living in a very complicated world where competition is simply part of nature. And the competition between East and West is not going to end anytime soon. And clearly, Saudi Arabia is a critical sort of centerpiece in this. And but what we see is the ability with the Saudis to reach markets that we'll never get to otherwise. I mean, what's going to happen in my prediction, once we get this done, inshallah, God willing, as we say, you'll see Indonesia follow suit. And that's 275 million people, the world's largest Muslim country. You'll see Malaysia follow suit. You'll see Israel being able to access markets in the ASEAN and in South Asia that it could never get to. And we'll do it together in partnerships. So the idea of working together and not just one side investing in the other, but mutual investments mean we've already proven the model in what we're doing in the UAE. We announced recently a $60 million co-investment project with ADIO, the Abu Dhabi investment office, where we're developing AI technology in Abu Dhabi. And we look forward to making that model work, because that's what will build really strong long-term ties between the kingdom and Israel, and then helping to integrate the larger region.
That was Jon Medved. He's founder and CEO of OurCrowd, talking to us from Jerusalem. Tomorrow at 6 p.m. Eastern Time, we'll have Wall Street Week. We'll talk to both Rashir Sharma of Rockefeller International, as well as Zanny Bedas, who's the editor-in-chief of The Economist. That's tomorrow at 6 p.m. Eastern Time, Romaine.
And you can catch David Weston every day around this time right here on The Close as we round out into the final trading. Back to Katie Greifeld, who's standing by with some breaking news.
We have some breaking news concerning NVIDIA. This, according to Wall Street Journal reporting that France's competition authority raided NVIDIA's local offices this week on suspicion that the company engaged in anti-competitive practices. The French competition authority, it disclosed the dawn raid rather on Wednesday. It didn't say what practices it was investigating, but people familiar with the raid said that the operation had targeted NVIDIA. Again, according to the Wall Street Journal, you can see shares still higher on the day, about 1%, but NVIDIA had been up as much as 2.3% earlier. From New York, this is Bloomberg.
It's about 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Let's get a view from the top here on this Thursday afternoon. Stocks trying to claw back some of the losses from the prior days here, but we're well off session highs here. And it's kind of a slew of breaking news crossing the wire just in the last few minutes. You mentioned the NVIDIA raid that we're learning about there over in Europe, a red headline crossing the Bloomberg terminal now on Tesla. We're learning that Tesla is now being sued for unlawful race practices. This is a lawsuit being brought by the Civil Rights Agency here in the United States. And then we just learned a little while ago that Endeavor, which just seems to be gobbling up everything, is actually now in discussions here about maybe taking a stake in that new golf league, which was basically the PGA, that then the Saudis sort of weaseled their way into buying. And now everyone's saying, can we really have the Saudis sort of controlling this?
And I believe we have the reporter who broke the story joining us on the phone now. Jillian Tan joins us now. And Jillian, I thought this was close to a done deal. You remember what happened earlier in the summer, of course, that shock merger between the PIF and the DP World Tour agreed to by the PGA Tour. Does this put that into jeopardy?
Yeah, so the story we just broke includes a statement from the PGA. It says their focus remains on finalising an agreement with PIF and DP, but the negotiations have resulted in unsolicited interest from other investors. This is something our colleagues broke last night, and we've just advanced it by naming two investors, being Ari Emanuel's Endeavour Group and then Fenway Sports Group, which owns the Boston Red Sox, Liverpool FC, and some other entities.
Give us a sense here when we talk about why we're now hearing about Endeavor, why we're now hearing about Fenway Partners. Was this something that was maybe always a possibility, or did this sort of crop up because of some of the concerns here about the Saudis' role in their ownership?
Yeah, I think it's been very well flagged. There's been opposition from U.S. lawmakers, stakeholders, fans, players, to a Saudi institution taking over a very storied U.S. sports organization. So, we reported that this could be an alternative transaction. It could be that these folks end up working alongside PIF, who actually have a right of first refusal. So it's actually hard to see them not being involved at all. But yeah, it's certainly an interesting development.
Yeah. All right. Our thanks there to Jillian Tan here. Of course, the big headline crossing the wire that Endeavor Group, of course, the company controlled by Ari Emanuel, as well as Fenway Sports Groups, which controls the Boston Red Sox, potentially exploring investing in the PGA Tour, according to people familiar with the situation.
Endeavor is a really interesting company, too. Remember, it's increasingly focused on sports. This month, I believe it completed its takeover of World Wrestling Entertainment, combining, of course, WWE with TKO Group Holdings. So they're making some big waves.
Yeah, big waves here. And it gets to this whole idea of just how much money now is flowing into some of these sports. And really, I guess we kind of say kind of the second tier sports, not no offense, but, you know, so much money goes into football and basketball, baseball, but golf, WWE. Katie Greifeld, running, track and field. Our cross-platform coverage starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms here on a Thursday afternoon. Markets in the green pretty much across the screen here, but a lot of volatility in between.
Yeah, absolutely. A lot of volatility seems to be the name of the game over the last couple of weeks. We're going to hear, of course, from the Richmond Fed president in a simulcast, Mr. Tom Barkin. So we'll be able to talk about, maybe we'll get some clarity in terms of monetary policy. But guys, the explosion of news in the last couple of minutes. NVIDIA still up on the day, up about 1.25%. But you're talking about that inquiry, right? A French raid of NVIDIA offices, the concern about competitive practices, which is pretty interesting. This has been the year, it feels like, for NVIDIA, right? On a tear, top performer. You think of AI, you think of this company. This is an interesting twist, perhaps.
It is, and we don't know, too many details about this yet. But one thing we do know is that regulators in Europe traditionally have been harder on big tech companies and big American tech companies. So that's important to keep in mind. In fact, the reason we saw Apple's new USB-C connector for its iPhone 15, Romaine, is a result of legislation in the European Union.
Yeah, they've certainly been leading the way here. And Carol, you mentioned sort of the fire hose of news. We were just talking on the television program here about this potential Endeavor deal. Of course, the company controlled by Ari Emanuel, which is kind of a serial deal maker. But according to Bloomberg reporters, that Endeavor is teaming up with Fenway Sports Group and exploring a possible bid into the PGA Tour. And of course, we know there's a big reason why. Of course, all the sort of hullabaloo of the Saudis starting their own league and then having sort of that backdoor acquisition effectively of the PGA Tour. And then everybody saying we can't let the Saudis control this. So we need some American investors. And well, here are two that apparently might be willing to step up to the plate.
It is a fascinating development in that story, which was already really interesting. And Endeavor, I find fascinating as well, because this company has been pretty aggressive in the sports world, not just with golf, but also with wrestling, a sport I have to admit I don't follow too closely. But apparently there's a lot of money in it.
You did call it a sport.
You
did call it a sport.
I did. I mean, it requires athleticism.
People
you can't
jump
deny
off the
it.
You
top
seem
rope.
like such a wrestling
There's
kind
also,
of
don't
gal.
forget about UFC also, Katie.
Love to get in the
UFC.
ring and just
UFC
Remember, like
is
Jimmy
huge.
Superfly Snuka? Am I the only old person here who remembers him?
Anyway.
Can we talk about this for a little while longer?
What? Snookums?
I mean, I think this is most interesting for the players, the PGA players who were upset about, some of their former colleagues leaving the PGA and going and playing for LIV and getting those huge paydays.
Can we just admit, though, this was kind of a mess, like the way this was handled from the start. Yeah, well, it still is.
Yeah.
Yes, thank you. But I mean, it was just kind of a mess the way it was handled. So maybe, I don't know, maybe they find a way to sort of right this ship.
Yeah, I don't know. We'll wait and see, right? It ain't done yet. And could they end up ultimately, being just another partner with Saudi Arabia and their public investment fund? Could they just be another partner in all of this? And does that make it more, comfortable for everybody involved in the sport, in terms of kind of getting it done and getting it through? Can we also talk about Tesla? I don't know. I think I heard you guys talking about
they're
sued
mentioned this. Yeah, go ahead.
for racial discrimination by the U.S. Equal Employment Opportunity Commission. They are talking about a hostile work environment for racial minorities at its California factory. Not the first time that I think that factory.
When I saw the headline, I was like, oh, okay, which case?
Perhaps.
Thanks for catching up.
I mean,
we should point out there was a state case that California had brought, but this is a federal case.
Yeah, I mean, perhaps that's why we're not seeing the stock move. Tesla first revealed that it faced an investigation by the EEOC back in April of 2022. That was in a regulatory filing, so this has been a long time in the making.
Hey, and if you want another headline, the Freedom Caucus down in Washington, they've actually told Kevin McCarthy, the House leader, they're not going to accept any kind of stopgap spending measure. They want it full.
What?
So there you go.
What?
Yeah. There you go.
Oh my God! Just never
Working
ceases
hard.
to amaze us.
535 members of Congress, 535 clowns.
Actually, and they're, I think, working.
How do you really feel,
I think
Romaine?
they're working for all of us, right? Don't we pay?
I don't think so. I think they're working.
Do
for
they get paid if the government shuts down?
Yeah, well, that's true.
Do they get paid if the government shuts down?
I think
Probably
they
not.
get paid under the table, Tim. You know that.
Oh, again, another Bloomberg opinion piece.
Romaine, I really like your suit.
All right.
Thank you. This might be the last day.
I really like that suit. That is
All
a
right,
good looking
guys,
suit.
we will be back in less than an hour's time. Lots happening on this Thursday. We'll count you out of the close. Beyond the Bell, join us at 4 p.m. Wall Street time.
We continue our markets coverage right here on Bloomberg Television, counting you down to the close, about 50 minutes until we get to those bells. A little bit earlier, we actually heard from Chicago Fed President Austin Goolsbee. He was saying that policymakers shouldn't put too much weight on the idea that job losses are needed to battle inflation, but instead focus on how different components of core inflation are decelerating. He said the unwinding of supply shocks, the composition of demand returning to more stable patterns, and Fed credibility are central to why I think it might be possible today to reduce inflation while avoiding a deep recession. Let's get some perspective out of our next guest. Samana joining us right now to help count down to the close, Senior Global Market Strategist over at Wells Fargo Investment Institute. And Samir, I do want to start off with Goolsbee's comments, which aren't necessarily outside of the norm. We've heard this from a couple other Fed members. But it gets to this bigger question here about what the debate is really going to be at the Fed over the next few meetings here about where rates go, whether they leave them there, and more importantly, how the market reacts to that.
Sure. Well, look, first things first, right? Let's see if they get data, right? Because if the government shuts down, they lose a lot of the data. Two, I think they've got to try and figure out what do the rise in energy prices mean for, the broader inflation picture, right? We have good work that suggests that truckers, shippers, they're going to be very quick to pass along these gas price increases. So we are coming up on a very important holiday shopping season, and so we're all going to be paying more for those surcharges. And the thing about those surcharges is they don't go away once energy prices fall back, right? They tend to kind of be baked in. So for all those different reasons, we don't see inflation going away. The real question will be how the Fed manages through that in a pretty, uncertain time.
What do you make of some of the market moves that we've been seeing over the past few weeks? Obviously, the big sell-off in treasuries, and for that matter, a sell-off in equities as well. Is that a symptom, or is that indicative of this idea that investors have just kind of called it quits?
I don't think they've called it quits, but I do think they're rotating very quickly from one market to the next. So it was all equities over the summer, and then I think they moved on to commodities, which is an area we're favorable on. And then I think more recently, I think people are seeing value on the long end of the fixed income curve. Now, again, that's probably a little bit of a falling knife right now, so you want to be a little cautious as to adding exposure. But we think those long rates are very attractive at current levels.
Well, why isn't anyone stepping in? Because I've heard plenty of people say that again, we're looking at 15-year highs. That's hard to resist. And yet you look at the price action, doesn't look, to your point, that anyone's catching that knife.
Look, it's not that people aren't stepping in. The tricky part is you have central bankers selling, right? Whether it's the Fed through quantitative tightening, whether it's the Bank of England, whether it's the ECB, whether at some points the Bank of Japan. The tricky part is when central bankers are selling, it's just very difficult to kind of offset that demand, especially when you have the curve inverted, right? If I can get 5.5% on the short end, I've got to really think long and hard about going out to 4.75 on the long end.
And plenty of people are running that math and just sticking in cash. But to your point that you have central banks selling, you also have, of course, the Treasury selling more bonds. And it feels like supply hasn't really mattered in the Treasury market for some time now. Is that changing? Is this a market where we need to think about how much debt is actually being sold?
Oh, absolutely. I mean, look, technicals, that's kind of it in a nutshell, right? Just supply and demand. And when you have the level of supply that we have, and then to your point, a cautious set of, kind of demanders, I think you have to take a little bit of a step back and say, all right, there's value here, but as we know, markets are very prone to overshooting.
When we talk about, I guess, the pockets of the equity market that have been attractive, we know obviously big tech was the big winner earlier this year. And there was not necessarily just a bet on growth, but obviously there was a certain defensive nature to some of that trade here. As we move forward, based on, I guess, wherever you feel the economy might go or where we are in this cycle here, do you think that there could be maybe, I guess, a re-up of that trade again in big tech?
You know, for us anyways, we do like large caps, especially over smaller caps, just because, again, that's where you have a lot of the financial flexibility, especially in what we see as a pretty tough environment. On the sector side, there are some pretty interesting opportunities. We like industrials, we like materials, we like healthcare, which I think some might say, you know, look, you know, if you're expecting a recession, those are pretty cyclical sectors, or at least industrials and materials are. And I think it's because there's really good valuations there. And the healthcare tends to be kind of your traditional defensive, but it's turned into a little bit of a growth area with some of these obesity-related drugs. So those are the three areas we would focus on.
You also mentioned that you're favorable to commodities right now. That's your general outlook here. Is that more of a supply story or a demand story?
It's more of a supply story. Now, I will say demand does continue to grow, and we think especially on the emerging side, it will, you know, continue to be pretty steady Eddie. But I think the supply discipline that we've seen, right, on the part of OPEC, on the part of U.S. producers, we think that's going to be something that continues for quite a bit of time. And so if demand is growing and supply is constrained, that's a recipe for what we think is a bull supercycle.
Does that translate into commodity-linked equities, or are you talking more about the actual commodities?
We like the actual commodity. So, you know, really heading into a recession, what you'll notice is the commodities tend to outperform the related equities, which is kind of what you've seen in the last few weeks.
And when we talk about healthcare in particular, you mentioned obesity drugs, and that's been one of the shiny objects that's emerged in the market over the past few months. I saw someone make the comparison that this is the AI moment for healthcare. Is that too far?
I mean, look, valuations are definitely stretched. So I will grant them that, you know, a lot of the gains have probably been brought forward. But I think, you know, even despite all of that, I think there's probably, you know, when you consider like the addressable market there, it probably is almost as large as AI, right? When you think about all the things that these drugs are supposedly going to help us with, right? Whether it's cravings for food, whether it's cravings for things like alcohol, you know, we'll see if it's, you know, like AI, all that it's cracked up to be. But at least the addressable market's pretty large.
Yeah. I don't know. I could have something to help me with my cravings for food. Cravings for alcohol. I think I'd rather hold on to that one for a little bit longer. Samir, a last question here. And this is more of a serious one, too. And it kind of gets to the idea of what we're seeing with Wegovy and these drugs. But the idea that overall this market and the economy seems to be at this inflection point where maybe we're on the precipice of something really new and potentially very positive for the economy. And it may take some time to get there. Is there just a conversation that you have with your peers over at Wells Fargo or with your clients about sort of how to sort of prepare for that day when it finally does arrive?
Yeah, I mean, look, it's all about sequencing and timing, right? So it's like looking out over kind of a valley, right? And the thing is, the bottom of that valley is probably the recession. So I would say, you know, probably the first part of next year, later part of this year are pretty tough. Right, we're going to need a recession. It's what, you know, kind of cures inflation, and then there probably is a pretty good recovery. Our target for next year is 4,700 on the S&P, so we do see brighter days ahead. So really, it's all about the price you pay for equities today in order to enjoy some of those future gains. So we think, you know, call it 4,100, 4,200 is a great place to start, you know, adding exposure. We were within 40 points of the upper end of that range just a few days ago. So, you know, really for us, it's more about discipline as opposed to being perma bears.
All right, Samir, got to leave it there. Really great to talk to you in person, too. That is Samir Samana, Senior Global Market Strategist over at Wells Fargo Investment Institute. Now, coming up on The Close, an exclusive interview with Richmond Fed President Tom Barkin, his insight on the Fed's potential next move and which numbers he's paying the most attention to.
And we get earnings after the bell out of Nike. Investors closely watching what the results will say about the health of the consumer and the outlook for retail. Those numbers, we'll deliver them to you as soon as they cross, Katie. But there's another big story.
Oh, big time. We're talking about why China is taking back all the pandas living in U.S. zoos and what it may say. All of them. They're all leaving early December. We're going to talk about what that says about the current state of relations between the two countries.
I feel a standoff is coming.
All that and more coming up. This is Bloomberg.
Welcome back to The Close. We want to return to some breaking news we got just a little while ago on Tesla. We're learning that the U.S. Equal Employment Opportunity Commission is suing the company over claims it created a hostile work environment for racial minorities at its California EV factory. Tesla contends that the state has exceeded its legal authority and says, quote, it uses litigation as a bullying tactic. The co-host of Bloomberg Technology, Caroline Hyde, joining us right now to talk a little bit more about this. And before we move on, let's just kind of parse what we know about different lawsuits, right? So I was aware there was a suit in California similar to this, right? The suit we're learning today is from the federal government, and it was part of an investigation that predated California's investigation?
Yeah, because already there's another investigation going on. It's a bit of a soup of letters that I'm currently going to run through, but two agencies. One is the Department of Fairness in Employment and Housing. The other one, which we're just learning about, is the Equal Employment Opportunities Commission. Now, we understand there's sort of a battle of those two agencies as to who has the most power within California. This is what Tengler is alleging, and that's why they're saying that they're taking to these bullying tactics. But ultimately, 3 years already investigation being done by the DFEH, and they claim that it was a racially segregated workplace. Now we hear from the EEOC that has also been doing years-long investigation, predating that 3-year-long investigation already, really talking about, I mean, turns of phrases are extraordinary. Severe, pervasive racial harassment. On top of that, remember, millions have already been paid out to one contractor, Owen Diaz, who was paid at one point $137 million. That got downgraded to just $3 million. But he too was claiming that really there were managers, no matter who you complained to, verbal harassment, graffiti in the bathrooms, and at no point anyone actually stepped in and took any real impact of this, changed the way in which this seemingly harassment is occurring in Fremont.
And as Romaine read, of course, Tengler has contended in court that the state is exceeding its legal authority, uses litigation as a bullying tactic. Given how Tengler has handled past accusations, should we expect more of the same from the company?
Well, we're yet to hear a response from the company, and it's notable, I think you were pointing out, Romaine, that the shares have tracked a little bit higher on the back of this. And actually, a lot of workers that sign permanent contracts with Tengler will unable to bring these sorts of grievances to the courts because they've got to settle in private arbitration scenarios. But notably, they have fought back verbally when these sorts of accusations have been thrown their direction. In particular, we heard sort of previously lawyers for Elon Musk and for Tengler more broadly saying when it was Owen Diaz, for example, saying there wasn't actually written formal complaints brought to HR, even though Owen Diaz himself said, look, I went and spoke to managers, I spoke to HR, but they've said, look, there were no formal complaints here that were written. So I'm sure that we'll get some sort of formal response.
Now, I don't go on Twitter much, or X. Katie is a big X person. You know, things have changed as of lately, so you have to kind of sift through a lot of nonsense to find anything of substance. But has Elon Musk actually responded at all on the platform yet to this? not
that I haven't sifted through in the last couple of minutes. It's broke, but I'm pretty sure that we'll see whether or not he does indeed. That's the way he's communicating, and we'll see as to know whether he speaks out. But as at the moment, I'm sure it's going to be left to the lawyers as well.
Have you been on X today?
Of course.
Okay.
She's there on it at the moment. You look. Has Elon Musk responded?
Nothing yet. But I think he's what's called a power user of X. So
well, he's the owner, so I would hope so.
We'll continue to monitor that situation. But Caroline Hyde, really appreciate your time. That is Caroline Hyde, co-host of Bloomberg Technology. Stay tuned. This is Bloomberg. Well, some sad news. The pandas in the United States are going back to China. I believe we have a live cam at the National Zoo in Washington, D.C., where you can actually see the pandas. And I'm not quite sure why, but the giant pandas that live at D.C.'s National Zoo.
That's a live shot, or is that a still shot?
No, that's live. Those pandas are alive. They sleep a lot. You know,
is that why they're having trouble staying?
I mean, they're enormous. They spend all day eating, and they spend all day sleeping.
I'm fascinated by this story. I mean, of course, everybody goes back to sort of the panda diplomacy during the Nixon administration and how China sort of gifted these things as a way, basically leased them to us effectively. We never really owned them. Now they're taking them back. But I remember at the National Zoo, I was living in Washington, D.C. when they first brought those two there. And this was a big deal.
And
I mean, the
you were
whole
there
town went
every
nuts.
day, right?
Yeah, every day, because everyone's just like knocking on the cage saying, hey, when are you guys going to mate? And then they tried everything. They found out that when they put these pandas in captivity, they don't really have an interest in mating for whatever reason. So they tried all these things. At one point, they were literally showing them. I think I said it was literally like panda porn. They were showing them, no, I'm not making this up. It was videos of other pandas doing it
read about
to
this.
try to sort of get them to do it. And they're looking at them like, just give me some more Band-Aid.
No, I did a lot of research for this segment, and you're right. But, they're tired. They spend all day thinking and eating bamboo.
Yeah.
I do want to bring you a quote that I love from this story. It's one of the most read on the Bloomberg terminal. This is from Lizzie C. Lee. She is a senior fellow, or a fellow rather, at the Chinese Economy Program at the Asia Society Policy Institute. Pandas have become canvases for narratives of distrust and rivalry. So there's a lot to read into this moment, that these pandas are going back to China at the start of December.
And they're taking them all back.
All of them. There will not be a single panda.
I wonder if there's going to be
United
protests.
States.
Like, do you think people are just going to stand outside the zoo or block the runway at the airport as they're trying to take little bow-bow?
Well, I don't want to speculate, but the zoo hasn't specified, I believe, an exact date that they're actually leaving. But it's early December.
Okay. Well, I have a feeling the close special edition on the day that happens.
Stay tuned. This is Bloomberg.
This is the countdown to the close. About 30 minutes left to go here, Katie, in the trading day.
And we're taking a look at stocks that are broadly higher right now, and you can see that on the sector level as well. You look at the big circle behind me, it's almost all green. You have just one sector in the red, utilities, off by about 1.7%. But you look up top, communication services leading the way, Romaine.
Let's take a look at some of the individual movers here. CarMax, one of the big decliners here on the day. In fact, having its worst day going back at least to mid-2022 on the back of some guidance that's really causing a lot of agita for investors. Workday, a similar story here. New guidance and not necessarily good, at least as the way it's being interpreted by investors. Those shares down almost 9%. Now, two interesting stories that are going out in the market right now. You're seeing a rise in AGCO and in Tribble. AGCO is agreeing to buy a technology unit of Tribble for about $2 billion. This is basically software that will allow AGCO's agricultural equipment to basically work a little bit better. You talk about AI, you talk about a lot of the automation going into these parts. The Trimble software hopefully going to be a big component of that. AGCO investors like that, and Trimble investors like the $2 billion that they're going to get out of it. Flip up the board real quick. I do want to go back to the broader market here, and we talk about sort of where the next leg of is in this downturn that we've seen. Is there the potential for a bit of a reversal? Well, if you look at the equal weight S&P 500, the answer might actually be no. Remember, you need much broader participation to sort of get that upswing that the market has been looking for, particularly in light of just how narrow the rally was at the start of the year. We do want to talk a little bit more about the macro, and I'm pleased to say that joining us in just a second right now is the president of the Richmond Fed, Tom Barkin, sitting down right now with our very own Michael McKee for an exclusive conversation. Michael, take it away.
We'd like to thank everybody who is watching us on Bloomberg Television and listening to us around the world on Bloomberg Radio for joining us today, and thank Tom Barkin for joining us today. Most people don't realize probably that Washington, D.C. is in the Richmond district, so you're in charge. If your constituents shut down the government this weekend, is it a big deal for the economy?
Well, I'm pretty far from in charge, as you well know. Well, so look, we have a lot of workers who are employed by the government, and of course, there are a lot of citizens who they serve, and this just creates uncertainty. And so I don't have any insight into how long this will last or what will actually happen, but as it plays out, there absolutely are implications.
Well, if it goes on for a long time, it is possible you won't have any of the government's economic data. You could go into the November 1st meeting without, say, jobs or CPI data. How does that affect what you do?
Well, of course, we economists want to think first and foremost about ourselves, so that's very good. But it would be hard to figure out what's actually happening in the economy without the jobs data, which is the best information on the labor market. It's hard to know what's happening in the economy without the inflation data, the PCE inflation data, which comes from the Department of Commerce. But we'll do our best. You take the environment as it is, and you do your best to figure out what's going on. And in my world, I just live every week on the ground, and I'm trying to talk to businesses and workers about what's happening in the economy, and I'll just double down on that.
Have you asked the Richmond staff to come up with any different kind of indicators for you?
Well, starting with COVID, we introduced collectively and have been tracking a whole different set of indicators. So I look at credit card spend, for example, as a good indicator of what's happening in consumer spending. And you can get that information, or we can get that information even weekly. There are a lot of alternative job opening databases, people who scrape online that we work with. So I think we're in a lot better shape now than we might have been 4 or 5 years ago, just because the uncertainty of COVID gave us a much more significant focus on real-time indicators.
Well, let me pick up on something you said there. You get pretty much real-time data on how consumers are doing. How are consumers doing? There's a theory out there that they're starting to pull back.
Well, the data on consumer spending, if you look at the last 2 or 3 months, has been extraordinary. And frankly, I think a little bit stronger than I see it, at least from the data I'm looking at. You know, for me, it looks like it's okay. It's solid. It's not extraordinary. And we'll see if the revisions prove right. And we'll get more data tomorrow, obviously, on that. But I think it's solid. Now, you've got to segment it. So the higher end consumer still has money, still has wealth. Equity values have been up. House prices are up. And they're still spending, especially on things like experiences and international travel. The lower end consumer clearly is having to reprioritize spend. And then I've heard some interesting indicators lately that the middle income consumer is starting to reprioritize as well. And that would all make sense in the context of eroding stimulus, higher rates, and the like.
What do you think that means for the fourth quarter? Third quarter, all the measures, the nowcasts basically see very strong growth, anywhere from 3 to 5%. Do we fall off a cliff in the fourth quarter? Is a recession a possibility?
Well, if you define a cliff as 3.5% or whatever the third quarter forecasts are, I don't see that kind of growth rate continuing. And so you have to always worry about your baseline there. Growth still seems solid. You know, we're only 2 days away from the fourth quarter. And as I said, I still hear a pretty solid business climate. But I'm anticipating the next quarter or two to be solid, not to be robust. And that's how I see it.
Are you still in the camp that thinks, well, I guess you probably are, because there's nobody in the summary of economic projections who said that there was going to be a contraction. You don't see that coming for the economy?
I don't think the kind of growth we saw in the second and third quarter feels likely to continue. I think it's going to come off of that. How much far off of that, we'll see. And that's, of course, you know, we have the luxury of time, I guess, to figure out what does happen. We've also got these uncertainties. You talked about a government shutdown, auto strike, oil prices, and the like. There's a lot of things out there that could have an impact on the economy. So, you know, I think I'm going to learn a lot from the next several weeks and several months.
Well, that raises the question of the Fed left in the dot plot one more rate move for this year. Is that a placeholder in case of emergency, or do you really think we need another rate move to bring down inflation?
Too early for me to know. I think there are a wide range of possible outcomes. You could argue for a resurgence based on the numbers we've been seeing. You could argue for a downturn, as you've been talking about, and you could argue for a return to the pre-COVID economy. I think all of those are in sight, and you'd have very different, medium-term rate paths against those outcomes. So that's why I like the chance to take some time and see what we see, particularly on demand, both core demand and labor demand, and then what we're seeing on inflation. And different scenarios for those things, I think, end up with different scenarios for rates.
I assume this means you're in the top line. There's only 2 lines for 2023 with one more move, or stay there. I presume you're in the top line that one more move could be necessary.
I'm in the camp of saying, let's see how the economy rolls out, and we'll respond appropriately.
What is your baseline forecast for the rest of the year, leaving these other possibilities out? I mean, you obviously can't know what's going to happen with the auto strike, et cetera. But let me expand it into the first quarter. Where do you see the economy going?
Well, I do think we're going to see demand soften. I just think that the combination of credit tightening and the rate impact, the lagged effect of rate increases has got to have some impact. So I've got demand softening. I don't think that's going to have the kind of trauma on the labor market it may historically have had, because people are still very loath to fire workers that they spent a year and a half trying to acquire. And so I think, in addition, businesses have been investing. It's been now 16, 17 months where the leading indicators have predicted a recession. hasn't happened yet, but businesses in their 23 planning and now businesses in their 24 planning are being cautious. And so the combination of that means there's just not as big a cliff as you might expect, even were the economy to slow.
But what are they telling you about employment going forward? Because you've raised rates 11 times, more than 500 basis points, and the unemployment rate basically hasn't moved. Are they hoarding workers at this point because it's hard to find them? Are they prepared to start laying people off, or do they think they can power through?
I think you've got two segments on the labor side. I'll call it the professionals and the non-professionals. The non-professionals are really the part that were short during COVID. And you'll notice if you look at these layoff announcements over the last 6 or 9 months, they're almost all professionals, support and overhead type of people. The skilled trades, the frontline workers, for the most part, aren't being affected. And that's because people are really worried you'll be able to find replacements should the economy come back. On the professional side, while there have been dislocations, that's a group that repots relatively quickly. And so you're not seeing it in the unemployment rate because they typically run unemployment at about 2%. And so it's just a very much lower unemployment group that can find other things to do. And so the dynamics of the unemployment rate are actually just different than, the kind of downturn that we're used to, like the one in 2008, which hit the people last in the workforce and the manufacturing and the construction workers the hardest.
Well, do you still think that unemployment has to rise in order to bring inflation down? Jay Powell promised pain, but so far you're sort of disappointing the masochists.
You're saying he's under-delivering on pain? No, I think what has to happen is it's very hard to imagine inflation settling while the economy is growing at significantly faster than trend. That just is a strange thing to believe. You'd have to believe it's all supply. And I think while supply has been a big part of this, it's not all of it. We've unleashed, unfortunately, people's ability to use price as a lever, and they will use it until it comes down. So I think there'll have to be some softening. But as I said, I don't think that softening is likely to hit the labor market in the kind of way that we're used to seeing because of this issue of people retaining workers and because of the issue with people who have already been cautious, with their hiring.
What are business leaders telling you about wages? Are they able now to bring down the increases and get them to a more sustainable level?
So if you think of merit pay, and most everyone I talk to is thinking about the end of the year merit pool, maybe it was 2 or 3% normally. Maybe last year it had to be 5 or 6% because of inflation. People clearly are seeing that coming down. Maybe half the people I'm talking to would say it'll be like it used to be. The other half would say maybe it'll be 3 to 4, not 2 to 3. And so I think bringing down price inflation overall has brought down those kind of expectations. The place where you're still seeing wage pressure is skilled trades. And, construction workers, even I've heard people who, assistants in veterinary stores, places where you need a degree, where demand has shifted up, nurses, and we just haven't had the supply. That's still a place that's got meaningful wage pressure.
I have to ask you about the bond market. You heard the anchors talking about the markets before we came on here. We've seen yields rising to levels that we haven't seen basically since the great financial crisis started. Does that worry you? Does that encourage you? How do you feel? How do you look at the bond market?
I don't know how people look at the bond market every day and keep, happy or unhappy. It seems like it moves. So I try not to spend too much time focused on it. What I will say is that financial conditions are the way that monetary policy work their way through the economy. Financial conditions, at least the part which were bond rates and equity values, actually loosened over the summer, and they're tightening back up again. And so I take it as one of many indicators that financial conditions are tightening, and then I'm looking to see whether that tightening has the kind of impact on demand and eventually inflation that we would want.
Is that one reason that you took some of the cuts for next year out?
Well, everybody did their own version of the SEP, and as you well know, it's a median, so it's not any one person's thing. But I think as I looked at the SEP, what I saw was stronger growth forecasts. I saw lower unemployment forecasts, and I saw inflation the same. And the only way those three things square is with the fourth thing, with this less accommodative monetary policy.
One more question. Tomorrow we get the PCE numbers for August, and there is the people who do the math on these things say if it comes in as forecasted at 0.3 or 0.2 on a month-over-month basis, it sets you up to come in below your brand new forecast for PCE. Do you think that maybe you're doing better than you give the impression in terms of bringing down inflation?
Well, the last 5 months of inflation, and they've been restated, as you know, have been encouraging. If you look at the last 5 cores, they've been 0.3, 0.3, 0.3, and then 0.2, 0.2. And there are a lot of people who estimate another 0.2 tomorrow. And of course, on a 6-month basis, that means you're at 3%. And I think on a 12-month basis, it would be 3.5 or something like that. So that's encouraging. And nobody in my shop is rooting against lower inflation. So we'd be very happy with that. We'll see what happens.
All right. Tom Barkin, thank you very much for coming in today, the president of the Richmond Federal Reserve Bank. We'll send it back to you.
All right. Thank you to our Bloomberg's Mike McKee and, of course, Richmond Fed President Tom Barkin. And Romaine, it was interesting listening to, of course, Tom Barkin talking about a sort of a bifurcation in the economy and in the labor market. The high-end consumer still doing well. And then you think about some of the skilled labor out there still seeing wage pressure.
But this gets to the idea. I mean, so many of the guests that we've spoken to on this program over the last few months have talked about just kind of how there's sort of different stratas to this economic story right now. So it's hard to just say in one fell swoop, okay, everything's bad or everything's good. It really is sort of bifurcated here.
And of course, when it comes to the Fed and their blunt tools, famously blunt tools, of course, they can't design policy for different stratas of the economy. You raise interest rates, that hits everyone. And when you talk about inflation, obviously the narrative there is that it hits some of those lower end consumers, those less skilled jobs more.
Yeah, absolutely. Here. Are you still into sports? I know you were in sports briefly earlier today when we talked.
Which sport?
Well, we talked boxing. We talked PGA Tour. Well, some more news on the PGA Tour. We learned a little bit earlier from our Bloomberg reporters that apparently there's a coalition of Ari Emanuel's Endeavor and the Fenway Group, which owns the Boston Red Sox, that could take a stake in the PGA Tour. We're now learning, based on Bloomberg reporting, that Henry Kravis of KKR also said to be among U.S. investors weighing a PGA Tour bet. So a lot of interest in this. I mean, obviously, PGA is a crown jewel for anybody here, but this gets back to the idea of why we're here in the first place here. The whole mashup with Saudi Arabia, I think, caused a lot of head scratching.
I would imagine there's going to be a lot more news breaking around this subject in the coming days.
All right, more sports coverage coming up here and a conversation with Nancy Tangler, Laffer Tengler Investments. This is Bloomberg. This is the countdown to the close. Romaine Bostick here alongside Katie Greifeld with about 10 minutes until we get to those bells. Markets holding on to most of the gains here on the day here, Katie, off the highs. But I think given just how awful the previous few days were, I think some people will take it 0.8% right now on the NASDAQ.
And I don't want to jinx it, but there's only 10 minutes left. So maybe I'll say it. We're looking at a second straight day of gains for the S&P 500. You rewind back to the start of the week, it was a much different picture, if you will.
A much different picture indeed. We should point out the yields still remain somewhat elevated here, although the big sell-off that we had seen earlier in the session is kind of reversed here, and now seeing some buying across the curve. Don't forget, Katie Greifeld, earnings after the bell. I know you're always waiting for earnings season to end. I have news for you. It never ends. Nike will have full coverage when those bells come.
And for more market analysis, let's welcome Nancy Tangler, Laffer Tengler Investments CEO and CIO. She's releasing her new book, The Women's Guide to Successful Investing, tomorrow. Nancy, it's great to see you in person on set in New York City. And I have a pressing question for you, which is this 2-day winning streak in the S&P 500. It doesn't sound like much, but is peak rate trauma in the S&P 500 starting to enter the rear view?
I think so, Katie. And I also think that what's kind of critical is we've been opening down and then ending the day stronger. Now, there is a lot of stuff going on at the end of the quarter, as we all know. So I don't want to read too much into it. But I actually didn't think the press conference was as bearish as many investors did. And I think what you saw was the algos coming in, driving down prices, tech in particular, which has actually held up, even in this sell-off, pretty well. So I'm encouraged. I think we get a rally into the fourth quarter. Maybe not right out, but by the end of the year, we'll be higher.
It's interesting to hear you say that, because I remember one of the narratives that emerged before the press conference was that, okay, the Fed is going to say they're on hold, and maybe we'll move past this very macro-driven market into one more driven by fundamentals, more driven by earnings. And then, you know, we've had the past week, so that narrative died on the vine. But now maybe as we get past some of the digestion of the press conference, could we enter into that type of environment?
Yeah, I think so. And I just wrote a piece about the dot plot. I mean, if you go back and look at it in September at 21, the dot plot indicated that rates on average were going to hit 1% in 2023 and 2% by 2024. So I think we put way too much emphasis on these short-term estimates, and that's what they are. They're estimates, guesses by the Fed and the members. So I think what you have to pay attention to is earnings. Earnings are going to be stronger in the fourth quarter, flattish for the third quarter, stronger in the fourth quarter, and then moving into next year, they're going to be up, low double digits. So market has obviously priced some of that in, but I think this earnings season, and Costco was a great example, sold off in the aftermarket and then had a nice day yesterday. So I think the consumers.
Did you know Costco's selling gold bars now? Yeah. Anyway, fascinating. But let's. I learned that this morning. But let's talk a little bit about earnings season, though, because I think most people expect we're going to see some softness, particularly in some of the consumer areas for the quarter that just was. So we're going to get those results. You're saying that when we get the results for the fourth quarter, that we'll see maybe a little bit of an upswing?
I think so, yeah, Romaine. And it's going to be sector by sector, of course. I've been so befuddled by investors selling off technology, big cap technology, in the face of interest rates. These companies have, one of the really interesting things, if you look at a company like Microsoft, higher interest rates have been good for them because they issued a bunch of debt. Some of it was left on the balance sheet in cash, and they're earning much higher rates on it, and their debt payments aren't going up. So the big are getting bigger, and I think the biggest concern for tech is the dollar in earnings, not interest rates.
Well, then that gets us to the question of how much further does the dollar go? There are a lot of people, I think, a couple months ago said, okay, the dollar strength, that's finally behind us. And then, of course, we've seen what's happened over the last couple of weeks.
Yeah, it bottomed the day I went to Europe.
Oh, okay.
So that's the perfect.
So that was you.
Yeah, that was the indicator.
Nancy Tangler indicator.
That's right. I think that is a concern, but we are the economy that's in the best shape on the globe.
Yeah.
So I'm surprised as well, and I think it may have a deleterious effect on earnings. So we'll be watching that. But we're going to be focused on revenues and margins for sure.
Are you discriminating by size, if at all? You mentioned that, of course, tech has held up maybe a little bit better than the rest of the market. When I think tech, I think big. Are you thinking about small caps and seeing anything you like, or is the play here to go big?
Plays to go big, I think, Katie. We did an analysis a couple of years ago, and small caps just have had a tough go of it. And if you look back historically, there's just brief periods where they outperform. We're investing, money for private wealth clients, and they've got taxable concerns. So I can't really tactically move in and out of asset classes very easily. So we're large cap. With a focus, we moved down the cap scale, so we might be considered all cap, but we're not focused on the small cap space, and I don't think investors need to be exposed there. Personally.
Let's talk about what you are focused on. And I love talking to you because you bring some stock picks. And I'm looking down your list right now. I see Oracle, for example. Talk to me about Oracle.
So we actually added the name about 2 years ago. We were adding to it pretty ferociously last fall. And then, it's done quite well, as you know. And then in this recent earnings report, I just didn't think it was that disappointing. And so we used the weakness to continue to add to holdings. I think this is a stock that can be one of the largest holdings in your portfolio. You've got a dividend, it grows, and you've got a strong management team that is focused on this AI computing business via OCI. Bookings doubled in the last quarter, and that's impressive, and I think it's going to continue. I hear people all the time on air saying, this AI thing is overblown. I just don't see it. I think Microsoft, Oracle, companies like Broadcom, and obviously NVIDIA, but those are names that are going to continue to do well because they're monetizing it.
I always love it when our guests bring stock picks, but you also submitted stocks that maybe you would avoid. And I saw two names on there that stuck out at me, Target and Disney.
Yeah, we exited a while ago.
Disney?
So, I think that company is confused.
Certainly so.
I'm privately referring to Bob Iger as Bob Ogre now. He's having to go in and really be...
Those are fighting words.
Yeah. But I guess I was shocked because I just think when I think Disney, the brand, and I think, okay, they're going through some issues, obviously, right now, but at some
they
point,
will come out the other side. I think it's just there's an opportunity cost, and so we were looking for other opportunities, places that we thought could recover quicker. The three business model is tough because when parks are doing well, streaming isn't doing well, and then you had all the management issues. So we decided there were some better places for us to be. Target, I just think you got a management that got sidetracked, and Walmart is eating their lunch.
And just real quickly, one of the picks that you did have that you said you were favoring was Honeywell.
Yeah.
Yeah, why?
So it's part of our theme, which is the old economy companies that are embracing digitization, and then the suppliers of those products. Honeywell has a pretty robust business in digitizing factories and other aspects of the industrial space. And so it's a new management team, still needs to be proven, but we like the dividend and the growth.
Nancy, great to see you. Nancy Tangler of Laffer Tengler Investments and the author of the new book, The Women's Guide to Successful Investing. We're counting you down to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. And here to help take us beyond the bell, Carol Massler, Tim Stenovic joining us once again here. Welcome to our audiences across all of our Bloomberg platforms. The price action in the equity market about the same when we last left you, Carol.
Yeah.
But a big reversal in the Treasury space. The sell-off has actually turned into a big bout of buying.
Isn't that interesting in terms, and what do you think it was that maybe Tom Barkin said, telling Mike McKee, of course, the president of the Richmond Federal Reserve. I mean, for me, what was really interesting is how he said he doesn't watch the bond market.
That was Carol's favorite part of the interview.
Why are we so focused? I'm like, he's like basically saying, slow your roll, everybody. Just kind of let it be. But I thought it was interesting. And then to have that kind of bond market reaction, whether it was off of some of his comments or what, I don't know, guys.
Hey, how did you guys find Samir Samana just now? I know you spoke to him before we did at the Wells Fargo Investment Institute. We just spoke to him, and I would say the conversation was, Katie, not quite upbeat. He's calling for a recession early part of next year. He has a year-end price target of 4,000 to 4,200 on the S&P 500. He's worried the Fed's behind.
I wonder who he liked more. Did you ask him that?
He definitely liked us.
Okay.
Yeah, more. Yeah, no doubt.
Yeah, it was interesting. I mean, speaking to him also, pretty bullish on commodities, though, to pair with that. That was pretty interesting as well.
Yeah, I mean, and he didn't seem too dour. I mean, he seemed to suggest that,
maybe we bring out the worst in people.
When you go, I mean, Carol has that effect sometimes. But, when you get deeper into 2024.
Again, I can hear you.
It's the same to suggest that. And I actually listened to part of your interview you had with him.
Thank you.
Yeah, it's,
really?
Yeah, believe it or not, I do listen to you
love
guys.
us? Okay.
I mean, love is a strong word, but I
That's
like
true.
it, guys. All right, guys, let's walk through the numbers here on this Thursday afternoon. Higher across the board for all of the major indices here in the U.S. The Dow Jones Industrial Average up by more than 100 points, back around that 33,600 level, about a 0.3% gain on the day. The S&P 500 just a smidge below 4,300, higher by about 0.6%. The Nasdaq Composite higher by 0.8%, and the Russell 2000 posting a similar move higher, about 0.9% on the day.
Yeah, it was kind of like a Sybil kind of day. I feel like we trade like that, right? It's like multiple different trend lines in a day, if you will. But in terms of the equity markets, what really caught my attention was what went on with the SOX, the Philadelphia Stock Exchange Semiconductor Index. 29 of the 30 names higher in today's session. The index up 1.8%. Micron, obviously, a bit of a bummer, and that was the only name that was down on the day on that forecast for a worse than expected loss. But man, Katie, that was definitely a group that was a standout in today's session.
Yeah, really interesting to see the rest of the industry rip on a day where Micron obviously did the opposite of that. You take a look at some of the industry groups. You also had autos having a good day, up 2.4%, and then semis, as we were just talking about, up 1.7%. Those were your biggest gainers. You go down the list, there were a few names in the red, not too many, but down there at the bottom you can see utilities once again in the red. That's some more defensive play, and the mood music was pretty good today, so utilities off about 2.2%.
The mood music?
The mood music.
That's really
I say that all the time. I need something else.
I like that. All right, let's get to some of the individual gainers, if we may. Peloton atop that list, at its highs, up more than 12% in today's session, finishing with a gain of about 5.4% on heavy volume, I should point out. News after the close last night, agreeing, I think we all were breaking it down, but we got some more color on it, agreeing to a deal with Lululemon to tap its online workouts and team up on apparel. Lululemon's going to make co-branded clothing that Peloton will sell on its website and at retail stores. And Peloton, meanwhile, will be offered to users of the Lululemon Studio Mirror. So a lot of integration back and forth there. So nonetheless, investors moving into that name. But, I just want to do a quick check. I think Peloton still down almost 40% for the year. And you did have Lululemon.
For the year. Why don't you do it from the highs?
Well, I
think that would start with a 9.
I had to give it a little bit of love.
And I just want to point out, I'm glad you mentioned the volume on that too, because I mean that's kind of one of the things that's held this stock back. There just really wasn't a lot of interest in trading it up or down, and I think we're something like like 4 to 5 times the average daily volume on this day, 47 million shares.
Where was it at a high? I'm just going to pull it up here.
Yeah.
It was like, what was it? It was a $167 stock, closing the day just under $5. So yeah, you're right. Okay, good point. Advanced Micro Devices, one of the semiconductor names. I just thought I'd throw it in there. Up almost 5% in today's session. As we said, no real news. Also on heavier than normal volume. Shares have gained about 60% year to date on that interest in AI. So just wanted to point that out. Chico's, this was an interesting story. I thought this was really interesting.
Yeah.
Up 63% in today's trade. What?
Yeah, no, go ahead. I mean, I'm fascinated by this. I mean, this was like, you talk about a fallen angel.
Absolutely.
Yeah.
But Sycamore Partners apparently finding some value, I guess, in this name, and you wonder about what they will do with it. $7.60 per share in cash. Stock closed just below that at $7.52 a share. Brands, of course, White House, Black Market, Chico's, and Soma. But I always feel like, those retail names, even though when they fall on hard times, there's always like a buyer, often in the investment world, that finds
But can they kind of get that cachet back? Because it seemed like there was this period, I don't know, like 10, 15 years ago where they were kind of all the rage amongst like, a certain cohort of women. And then it just kind of, I don't know, it just never really evolved, the styles or anything. And I don't know if Sycamore could do something with it, great, but I don't know.
I actually, no kidding, I have a Chico's cardigan sitting at my desk right now.
Do you really?
I do.
Right next to your Hokas?
Are you that sort of kind of women? Like, how did you
I don't know, apparently. I don't know.
Biggest move since 1993
Well,
when the company went public.
Wow.
There you go.
At the highest level since 2018.
I remember where I was in 1993.
Do you?
Yeah.
You don't?
I was barely alive.
All right, let's
Thank
do
you,
decliners.
Yeah.
Carol has the gainers. I'm going to go ahead and do decliners.
This is what she just
CarMax
said
finishing the day down more than 13%. Biggest
bond
decline for
market right now.
CarMax in more than a year. Shares falling after the company fell short of analyst profit estimates for the current quarter. Sales lower amid higher interest rates. Higher rates for loans weigh on the used car business, of course. CarMax, get this, said the decline in profits was the result of higher prices, higher rates, tightened lending standards, and lower consumer confidence. Used vehicle sales down 7.4% from a year ago. The company's CEO telling investors that some customers are trading down to different cars so they can afford those higher payments. When interest rates go up, that means those monthly payments go up. Shares of Micron finishing the day lower as well. They fell after the company predicted a steeper loss than anticipated in the current quarter. Shares down 4.41% today. That indicates an industry slump is still weighing on the largest U.S. maker of memory chips. And shares of Workday falling the most since 2020. This after the company trimmed its long-term forecast for annual subscription revenue growth. This was during an investor presentation earlier today. Shares down by 8.5%.
All right, let's take a quick look at what went on in yields. At some point on the day here, it looked like we were going to get a continuation of that bond sell-off, but we did see a reversal here late in the session here with some buying coming back in, and of course that ended up shifting the curve down across the board, down about 7.5 basis points on your 2-year yield. On the longer end of the curve, it was a little bit less dramatic, only about 1 or 2 basis points there here. But it really gets more to this whole idea, guys, of just the volatility that we continue to see in the Treasury space, a Treasury market that, of course, is supposed to be the most liquid, the less riskiest, and of course it's trading on certain days like a meme stock. And of course Tom Barkin says he doesn't even pay attention to it. Should point out here, I mean, since I know how much you love Fed speak, Carol Massar, that Jay Powell is actually speaking right now. He's actually hosting a virtual event. This is basically a town hall with educators. You see him there on the screen there, basically talking about education and I guess that education is good. We're going to listen into that and bring you any headlines as we get them. If you do want to listen into it yourself, just type live go on the Bloomberg terminal.
And we do know that Jerome Powell definitely pays attention to the bond market. Last Wednesday, of course, he mentioned real yields a number of times. Of course, that is yields that take into account the impact of inflation.
I thought that was the name of your show, Katie.
It is, actually. And real yields, again, when you strip out the impact of inflation, that is, they're extremely high right now. I know we've been spending a lot of time talking about the size and scope in nominal yields, but the real yield matters because you think about the borrowing costs for all of these companies that we talk about all the time. That's what it is. That's the tightening of financial conditions.
Can we go back to Jay Powell? Because I'm just reading Craig Torres and Laura Curtis putting out a story, and Jay Powell saying the Fed's ability to influence the economy depends on whether, quote, people understand what we are saying. When Fed officials publish their projections for interest rates in the economy, quote, one of our goals is to influence spending and investment decisions today and in the months ahead.
Well, we know they influence the decision-making of executives at
Just thought it was
companies, but
interesting.
I don't know, Romaine, how much the actual regular person who's going out and spending money actually cares what the Fed has to say about inflation.
But he's talking about people like understanding, like their financing.
Well, inflation
and
expectations are very
Fed.
important, and that's why high oil prices are such a concern for the Fed.
Yeah, but it gets to the idea, too. Like, I mean, he doesn't necessarily have to speak to, the people on the ground. You speak to the financial markets and the economists, and in theory, that sort of message trickles down. And we know that this is a Fed, at least in terms of policy, where the communication mechanism today is probably way more important than the policy change itself.
If you're going to, going to the grocery store and it's like, $18 for a pound of deli meat, do you need the Fed to tell you that inflation is high?
Yeah, but maybe you'd like to hear the Fed say that they care a lot about it and explain in plain English what they're doing about it.
Well, I just printed up all these little stickers of Jay Powell, and it just says, I did that, and I put it right next to the price of eggs.
That was you?
Yeah, that was me. Yeah.
Wow.
Yeah, I have a lot of free time.
Apparently.
This show isn't my life.
Don't you feel like every
just
day,
3 hours.
everybody, we learn something new about Romaine Bostick?
Try.
You don't want to know.
I know.
I still love that suit.
Thank you. Thank you, Tim. I love the suit, too.
I love when the guys
Very
do.
nice.
Where's your tie, Tim?
No.
Still
Tim
learning how to tie.
Tim hasn't worn a tie since 1993.
That is true.
He has not. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We will see you again. It will be Friday tomorrow. Join us for our coverage at 3 and 4 p.m.
And just a reminder, it's actually Friday somewhere right now. Stick with us here. A lot more coming up here on The Close. We're going to take a look at Nike. Those results due imminently here. Interesting read, not only for what's going on with the apparel and footwear maker, but maybe a better read on the broader consumer spending landscape. This is Bloomberg. If you had any doubt as to why the markets moved higher on the day, you can thank the Magnificent Seven for that. The big cap tech cohorts, the Amazons, Metas, and Apples of the world, higher on the day. But of course, if you have a question here about why the market is down so much in the month of September, you can also thank that same set of Magnificent Seven stocks, a Bloomberg index tracking those stocks. You can see the big downdraft that we've seen here in the month of September. A big part of the reason, and more importantly, a big weighting here that has actually whipped this market around back and forth. The big question is where the next leg of this market goes. If it is to the downside, it's certainly going to be led by those names we were just talking about. If it's to the upside, it'll also probably be led by those names we were just talking about. For the day here, the S&P trying to claw its way back to that 4,300 level. The NASDAQ having a pretty good day as well, as is the Russell 2000. And that is key because any sort of sustainability of a new bull market, any sustainability of a resurgence in equity prices overall, you're going to need broader participation. And for that, you need small caps and you need cyclicals. You're also going to need some help, maybe potentially from the rates market. At least for right now, you're not really getting it. You did see a downdraft in rates across the curve here on this Thursday, but there was a lot of volatility to get there. At one point in the day, we saw rates continuing to move higher at those multi-year highs, including that 30-year yield, which is still camped out around 4.7. And of course, a lot of predictions right now, whether it's the folks over at TD Cowen looking to short, whether it's the folks over at JP Morgan looking at the potential for 6% on that benchmark, higher yields could be a big factor, Katie, and whether this market ends up lower.
All right, well, let's talk about one of the big data points that we got this morning, and that was the pace of U.S. consumer spending at its weakest point in a year. Now, according to data published this morning, spending advanced at half the pace as previously reported in the second quarter. And for more, we're joined by Bloomberg Economics chief U.S. economist Anna Wong. And Anna, does this change at all the narrative that the U.S. consumer has been very resilient and remains resilient?
Yeah, so I think that this does change the narrative a little bit. Before the revisions, it looks like there's more hope for soft landing. But I think what we saw today in the revisions is not just this downward revision to consumption, but also upward revision to core inflation. So at the end of 2022, core PCE inflation was actually running at 5.1% as opposed to 4.8% that we thought it was. I think had the Fed known that that's the real what the inflation was truly at, then they would not have skipped a rate hike a couple months ago. So I think today's revisions clearly show that there is an upside risk to how high rates could still go. I think the Fed might just follow through with that additional hike later this year, just because inflation is actually running higher.
We're talking about revisions, of course, to quarterly data from a quarter that is now basically 3 months past. I know we're going to get some monthly data on personal consumption and spending tomorrow, I believe, tomorrow morning here. What are those numbers going to tell us, and are they going to be materially different from what we saw in the second quarter?
Yeah, so those numbers would be very nice. It will show that both the core and super core inflation is trending at a 0.2% monthly pace, the third consecutive month that it's been running at that place. That said, because of the upward revisions to the contour of core inflation, I think that the 12-month change in core PCE, even after tomorrow's pretty soft report, will overshoot the Fed's forecast of 3.7% at the end of this year. It likely is going to be either 3.8 or 3.9. So this means that there is definitely an upside risk for another rate hike coming in the rest of the year.
Anna Wong of Bloomberg Economics, of course, talking about the main pillar of our economy, consumer spending. And let's get a read here from one of the companies that is part of that, Nike. Those earnings crossing the wire right now. And here are your numbers here for the fiscal first quarter. EPS coming in at 94 cents a share. That's about 1 cent more than what the street was looking for on average. Revenue coming in at $12.94 billion. That's a smidge below the average of street estimates, which were basically $12.99 billion. So a modest miss on that number. Inventory levels coming in slightly below what the street was looking for at $8.7 billion. And I know, Katie, you're really interested here in the China revenue, Greater China revenue, coming in the quarter at $1.74 billion. That's a miss. Street was looking for 1.83. And just real quickly, Katie, a correction here on the EPS number. It was 94 cents a share. The street was looking for 75 cents a share. So a much bigger beat than what I said from a penny, 94 to 75. You do the math there, Katie Greifeld.
Not very good at math, but you can see that the shares bouncing around after hours. Not quite sure what to do with that. Currently about 0.7% higher as traders parse through some of those numbers.
All right, let's get some insights here on what's going on with Nike and maybe the broader consumer space as well. Michael Wolff is the founder and CEO of Activate, and he joins us now here in Studio 2. And Mike, let's start off first, I guess, with kind of what Nike represents here. Is it a luxury brand? Is it just kind of an everyday consumer staple at this point? What is it to you?
I mean, it's still the favorite brand among so many people. Tremendous amount of brand power, and yes, it is a luxury brand if you compare from a pricing perspective, but that brand has so much power. And when you look at the growth over the last couple of years on a compound annual basis between 21, they're 23, they're on a fiscal year, you see about a 7% growth. But even between 22 and 23, they had 10% growth. I mean, it's the law of large numbers. They've gone from 46 billion to 51 billion from last year.
And we talk about a growth, though. I mean, at least in the last few quarters, has slowed. The growth rate still growing in terms of revenue here.
Yes.
When we talk about the power of that brand here, how much of an immunity does that provide for a potential downturn in consumer spending?
In a lot of ways, people keep looking at this and thinking it's a bellwether for consumer spending. And if you look at the earnings, they've really been affected not because of consumer spending on their products, but really because they've had way excess inventories, which they've had to burn off. As a result, they've increased their SG&A because they're advertising to get rid of it. And China is a huge challenge for them. And it's not just about the Chinese economy. They have a strong competitor in Li-Ning, which is a Chinese brand. And in a lot of cases, it's for a lot of Chinese consumers, it's preferred.
Is it preferred because it's better, or is it preferred because of the political climate where the Chinese government says support Chinese companies?
Well, it's the political environment. They don't have anywhere the kinds of near star athletes. But the bigger story about Nike is the transformation of this company into a direct-to-consumer business. And into one that is digitally enabled and one that is driven by e-commerce and AI.
That's a good point. Okay, I buy a lot of Nike products. I can't remember the last time I bought one from a third party. I'd go directly to the website.
Well, to that point, I mean, you have Romaine on one end, but where are they in that transformation to becoming a direct-to-consumer company, and where's the limit there?
But so in the last couple of years, they've eliminated 50% of their retailers. So right now, on a direct basis, they're around 45% of their volume is direct through their own outlets. They're expecting it's going to go to 60%. 25% of their sales are all digital. They're e-commerce. And they're expecting that also to go up to 40%. So this is a remarkable transformation. There are very few transformations that we've seen of a company in this direction. I mean, the only example I can think of that comes to mind is Adobe going from box software to being a SaaS company.
And really quickly, unfortunately, we only have about 30 seconds left, but meditating a little bit more on the power of the brand. You think about some of the U.S. competitors, especially in the running category. I'm thinking Hoka, for example. How does Nike stack up against that?
Well, Nike in a lot of ways is a cult unto itself. I mean, it's less about the functionality of the shoe, and it's much more about being part of their overall ecosystem and identifying with that brand.
All right, Michael, always great to talk to you.
Great to be here.
Michael Wolf is the CEO over there at Activate. A closer look at Nike earnings. Those shares higher in after-hours trading on the back of revenue coming in relatively in line with estimates. EPS beating here, and gross margin also coming in slightly above estimates. Coming up here on the big program, the U.S. may be heading for a double-dip vibe session. This sounds like a Katie Greifeld type of conversation. Bloomberg opinion columnist Jonathan Levin going to be joining us after the break. This is Bloomberg. All right, apparently the U.S. is at risk of heading back into a vibe session. At least that's the opinion of our next guest, a Bloomberg opinion columnist, Jonathan Levin, joining us, saying that that's when consumer confidence and other economic vibes decline so much that they threaten to become self-fulfilling prophecies and drag the economy down with them. Jonathan joins us right now here from beautiful Miami, and obviously we need to give a hat tip to Kyla Scanlon for coming up with that term, vibe session, or at least coining it and making it popular here. And then you had a little bit of a mea culpa, saying that what you had predicted originally didn't necessarily come out to be true, but now we're kind of back at that same level again.
Yeah, exactly. I love this concept of the vibe session because, consumer confidence, business confidence, the whole U.S. economy is so much of a confidence game in so many ways. And the strange thing about 2022 was that the vibes were way off, but the real economic data was actually pretty decent. Then, earlier this year, it really seemed like confidence was on an upswing, and here we are going back down. The point that I make is, confidence can often be sort of a self-fulfilling prophecy. It wasn't in 2022 because we didn't have those built-in vulnerabilities, I think. But this time around, it feels a little bit more delicate, the situation.
And sorry, Jonathan, Katie and I are having some communication problems
we're
here.
Fighting, sorry.
But I am curious. I mean, you hosted this event. And I mean, I was going through the comments here, and the idea here is that when you look at kind of the resurgence in energy prices as of late, the fact that the cost of a home is just getting more difficult, not only just because of the price, but obviously the ability to finance here. This seems to presage this idea here that I feel like this double dip, if that's where we are headed, that this dip, the second dip, might actually be worse than the first.
Yeah, I think that's exactly right. And as you underscore, the mood is bad when people talk about like what's going to happen, not the present situation. And they have good reasons to be concerned, right? You have student loans restarting, homes are extremely unaffordable. And, as I said previously, I think that all of this has the risk of becoming a self-fulfilling prophecy, and that's dangerous at a time when, excess savings are becoming depleted, mortgage rates are surging, oil is as expensive as it is.
And Jonathan, I love this piece because it really gets into the psychology of the economy, of people that exist in the economy. And it kind of reminds me back a year or two ago when it feels like everyone was predicting a recession, even though the economic data at the time was pretty good, aside from, of course, sky-high inflation. And that kind of creates a loop that if you think that there's going to be a recession, you start behaving as if there's going to be a recession, and it's sort of a self-fulfilling prophecy.
Yeah, I think that's exactly right. I think oftentimes consumer sentiment, consumer confidence are actually pretty good predictors of what's going to happen in the real economy. I think that didn't end up being the case in 2022 for a series of idiosyncratic reasons. Like we all termed out our debt, termed out our mortgages. We had this amazing cushion in the form of excess savings. And so what we were so certain was going to happen in 2022 didn't ultimately come to pass. My point here is that here we're going back in for another confidence swoon here in 2023. I'm not predicting a downturn or anything like that. I'm just trying to say, look, a lot of the things that protected us last year just aren't there to the same degree this time around.
Jonathan, when did the vibes get better?
Well, the tricky thing is, like so many of these things feed off of each other. I think, one thing that's interesting about consumer confidence, it tends to go down when the stock market goes down. What's feeding what? Are the declines in stocks feeding the drop in confidence, or is it vice versa? We just get into these sort of doom loops, and you really need something fundamental to change. Maybe it's what's going on in energy prices to really improve the vibes.
Yeah. All right, John. I'm gonna have to leave it there. Always great to talk to you. Great columnist here for us at Bloomberg Opinion down there in beautiful Miami. Stick with us. We're going to talk with the founder of a startup that uses VR headsets to train people for jobs. That conversation coming up after the break. This is Bloomberg. Another choppy trading day here in U.S. markets here on this penultimate day of the month and, of course, of the quarter here. The net effect of it was an S&P 500 higher roughly by about 0.6% here on the day. The NASDAQ managed to push a little bit higher, closer to 1%, but you actually saw an interesting bid come back into the cyclical space and come back into some of those small caps. Now, whether there's real conviction behind this still remains to be seen, but for a market right now that seems to be left to its own devices and particularly ahead of what could potentially be a somewhat disruptive government shutdown this weekend, this might be as good as it gets for a month that is going to go down as the worst of the year. In the yield space, we did see a downdraft here in the yield space on both the 2-year, the 10-year, as well as the 30-year. The entire curve shifting lower here. But even with that shift lower, you're still talking about yields right now camped out around the highs that we last saw back in 2006 and 2007. Katie?
Let's switch gears away from the market and talk about the startup company Transfer. It's just closed a $40 million Series C funding round. And of course, it uses VR headsets to help train workers for, quote, middle skill careers. Now, that's defined as jobs that need more than a high school diploma, but less than a college degree. And I'm thrilled to say that joining us now is Bharani Rajakumar, founder and CEO of Transfer. And 2 points to start. Number one, congratulations. And number two, talk to us a little bit about the fundraising environment right now. Obviously, you just successfully raised money. What was the process like given the backdrop?
Sure. First of all, thank you so much for having me. I'm super thrilled to share our news. As you said, we closed a Series C. It was led by ABS Capital. A gentleman by the name of Phil Clough, who's the chairman there, has joined our board. We're thrilled to have him. As you said, it's a pretty tough environment to fundraise, so we feel really fortunate. That being said, we also are lucky to have a up round. It wasn't a down round or stale. But I want to tell you a little bit just about what Transfer does for a second, because I don't know that everybody has heard of us. So what we do is we're creating a platform for enabling people to get on a pathway to upward career mobility. And we focus on jobs that do not require a 4-year degree. So jobs such as in manufacturing, in the skilled trades, in healthcare. And the way we do it is we create these job training simulations in virtual reality so people can put on a headset. They can do the job before they get it. So when they walk into the interview with the employer, they have the confidence that they have the skills, and the employer can see that they are capable and job ready.
So you're selling this directly to the employer, right?
Well, to maximize our impact, we work with high schools, 2-year colleges, unemployment offices, and nonprofits that share our mission, such as the Boys and Girls Club.
Okay, because that's what I was going to get at. I mean, I'm old enough to remember when you had shop class in high school and they taught you some of these trades, even if you weren't going to use them. The idea was that this sort of provided you a sort of a broader base to determine what you wanted to do in life. And of course, we know with budget cuts in education, a lot of that stuff has gone by the wayside. How receptive have some of these departments of education and other organizations been to this technology?
Well, they're really excited because, you know, one of the challenges right now in the macro environment that's talked a lot about today that was less so 5 years ago is that right now there are about 10,000 to 11,000 people, baby boomers, that are retiring per day. And so there's a lot of people leaving the job market. Meanwhile, there are not a lot of people that are, you know, leaving trade schools because for the last 3 decades, most people thought that the only way to have success in America is to get a 4-year degree. And so because you have this supply and demand imbalance, now you have people leaving the market and nobody with the skills to replace them, that's creating an opportunity. So the Bureau of Labor Statistics, for example, says there are 10 million jobs that are available and there are 8.1 million people looking for work.
How do you determine sort of what types of jobs you target, though? Because, I mean, we know there are certain jobs now where there's a big skills gap, but there is also jobs that may actually be gone at some point because of automation. And there are other jobs, particularly with some of the new semiconductor plants that are being built, where you've heard the companies say there just aren't enough Americans out there right now to have the skill set to actually come into these factories and start work on day one.
That's right. So the jobs that we focus on jobs that pay $50,000 to $100,000 a year, and they don't require a 4-year degree. So I want to explain just how this is kind of playing out for various sectors. So in the automotive sector, for example, you have companies like Tesla and Toyota, and you know, the automotive sector is going to need about 400,000 auto technicians by the year 2030. And right now, there are only about 40,000 that are entering each year, and you got to account for the folks that are leaving each year as well. Meanwhile, in the electrical space, so we work with a company called Trio. The U.S. Department of Energy has a net zero emission goal by the year 2050. They're saying they need 900,000 electricians. Right now, there are only 800,000 electricians, and the big problem is about 50% of them are over the age of 45, so they're going to be retiring in the next 10 years as well. Lastly, in healthcare, depending on what report you read, everyone agrees that there's a nationwide shortage in nursing. Depending on what report you read, there's up to a shortage of about 1.1 million people by the year 2030. So this is what's kind of creating the opportunity for, like you said.
So you're training nurses too?
We're training people who want to go into that career pathway.
I got you.
That's
okay.
right.
Oh, interesting.
And I'm glad we're having this conversation because a little while earlier on the program, our Mike McKee was talking with Richmond Fed President Tom Barkin, who made the point that there's bifurcation in the labor market. And when you look at the middle skill sector and you see the data coming through on your businesses, what is the health of that segment of the labor market?
Yeah, it's a good question. I mean, what we're seeing is that there's still a lot of opportunity for hiring, right? And to your question earlier, you know, the reason why I think our customers are excited to work with us is they need a plan for folks after they move on in life, right? So far, the plan has been go get a 4-year degree. Well, about 50% of people do not actually finish the 4-year degree program. And so the opportunity really is filling this supply and demand gap. And I think the other thing that we're seeing is that there's an opportunity for populations that were previously not focused on. So for example, the re-entry population, these are folks who were previously incarcerated. JP Morgan says that about 33% of Americans have a arrest history. That's a lot of people. We don't want those folks to, you know, go back into that situation. And so the best way to do that is to help them get a job.
Let's talk a little bit more, too, about that Series C that you just finished up, $40 million. What do you plan to do with the money?
Well, you know, we've got a great company, about 220 employees. So we're going to hire some senior leadership to help continue our trajectory. The other thing, we've mostly been focused on the English-speaking population, so translating these hands-on trading simulations into Spanish to allow accessibility for a larger population. We also work with rural communities all across America, so we want to expand accessibility to the states that we're not in. We're currently in about 40 states. We want to be in all 50 states, and we want to expand beyond, you know, manufacturing and healthcare as well.
All right, Barney, this was a great conversation. It's great to meet you. Interesting company here, interesting take here right now on the skills gap in the labor market. Barney Rajakumar, he's the founder and CEO of Transfer. Stick with us. A lot more coverage coming up, including a check-in on where we stand with that government shutdown. The countdown clock is up. Time is running out, and last time we checked, no deal on the table. This is Bloomberg. All right, next year, the 2024 presidential election will take place. Right now, the Republican Party trying to decide who will be its nominee. They held a debate last night with at least 7 of the potential contenders there, including former Vice President Mike Pence. He sat down with Bloomberg a little bit earlier today to talk about why he is the right nominee for the party. Let's take a listen to some of that conversation he had with Joe Matthew and Anne-Marie Horton.
Last night's debate was at times chaotic, but I really welcome the opportunity to make my case that I believe that while the former president and some others who were on that stage are steering our party away from Ronald Reagan's agenda of American leadership in the world, fiscal responsibility, even the right to life, that I'm the most consistent and tested conservative in this field.
And that was, of course, the former Vice President Mike Pence, now a current candidate for the Republican Party's nomination for president. I believe Anne-Marie Horton is standing by right now, who helped to conduct that interview a little bit earlier. And Anne-Marie, it was interesting to hear him kind of invoke Ronald Reagan. Obviously, they had the debate there at the Reagan Library, so that makes sense here. But this is something actually we've heard from some other Republican candidates as well. The idea that the party has sort of strayed too far away from at least their ideal of what they viewed Reagan's policies as being.
Right. When you looked at the debate stage yesterday, it seemed like everyone was trying to own up to Reagan's legacy more than the next person. But the real issue is that they are dealing with populism in their party. And the former Vice President Mike Pence speaks about this a lot. He calls it the siren alarm when it comes to populism creeping into the Republican Party. And he was answering a question I said, which was, were you not responsible for making populism okay within the Republican Party, given you signed up to be the VP for the former president, Donald Trump, who had this populist rhetoric going back to 2015 when he made that entrance down the golden escalator at Trump Tower. But this is obviously an issue that also they are dealing with when it comes to polling. The former president continues to dominate in the polls, even though you do have other candidates on stage that are talking about more conservative values. It doesn't seem like at the moment, when you look at national polls, that Republican primary voters are buying it.
And Anne-Marie, it's a busy week in D.C. Of course, we had that presidential debate last night. We're also really hurtling to that deadline for when a shutdown would take place. What's the current state of play? Has there been any progress?
Well, I think what you can expect is that the government will shut down this weekend. I think the next question is for how long? Is this going to be just a few days? Could it just last the weekend? As some individuals told Joe and I this week, like Jeannie Shanzano, Rick Davis, they think potentially it's a 48-hour shutdown. But if you look at what Goldman Sachs is putting out, Alec Phillips is talking about this could last 2 to 3 weeks. And then it starts to become very difficult. And already Congress is preparing for a lot of federal workers not to be showing up for their jobs starting October 1st.
Anne-Marie Horton, the co-host of Bloomberg's Balance of Power, which airs right after this program here. A look at the countdown here to the potential government shutdown. And a little bit earlier, we had a chance to hear from Richmond Fed President Tom Barkin. He was asked about the potential shutdown's implications for the Federal Reserve.
We have a lot of workers who are employed by the government, and of course there are a lot of citizens who they serve, and this just creates uncertainty. And so I don't have any insight into how long this will last or what will actually happen, but as it plays out, there absolutely are implications.
Yeah, a lot of people don't really know how long this will last. A lot of people aren't even sure it will start. Courtney Rosenberger-Gelman joining us right now, Managing Director of Policy Research at Strategas Securities. Hey, Courtney, let's just start off, I guess, with the big question. Do you think we will actually end up with that shutdown this weekend?
Yeah, thank you for having me. We're about at 100% odds of shutdown at this point. There are still intra-party disagreements, let alone inter-party disagreements. So we do think that we are going to shut down after Saturday night.
All right, I was hoping you would give me some good news here. So now to my second question is, how long do you think it would last? If we do get to that point here, obviously a lot of people, they talk about the partial shutdowns that only lasted a little while. But of course, a lot of people worried that this time is different, that the politics in Washington are just in a much different place. How long do you think it could potentially last?
Yeah, so we see consensus on how long a shutdown would last at about 12 days. We do think that there's a possibility for this to be a little bit faster since it is just a handful of Republicans in the House that are delaying a continuing resolution from getting passage. But we're also now starting to see some issues in the Senate on a CR with potential issues on immigration. So there's not a lot of clarity. And I think that, how long the shutdown lasts is really the big question and the big determinant of the ramifications, both politically for the Republicans and Democrats, as well as the ramifications for the economy as a whole.
And what's really interesting to me is the potential impacts that we could see on economic data that, of course, we parse very closely, and of course that the Fed relies on to make policy. And of course, we've talked about how the releases could be delayed, but there's also the question about quality of data and data collection. If we do see a government shutdown of multiple weeks, what could that mean for the data that we get for October?
Yeah, I mean, that's the big concern. One of the big concerns that we have, data ready for release could be delayed, and then data collection efforts in October, depending on how long the shutdown goes, we're not going to be able to get that data. So the FOMC has a meeting October 31st to November 1st, and they might not have all the data they'd ideally like to be making decisions. And certainly in a period where we're having labor strikes, high gas prices, student loans restarting, the shutdown itself, it's not a good time to have a lack of clarity for a data-dependent Fed. We do think that given the timing, the September data, while unpublished, they can probably get a hold of it by October data. If this goes into the second week of October, that's the reference week. They're not going to have that data, and that's certainly concerning. They're going to be relying on ADP, other private data sources. It's just not an ideal situation in a period where we have a lot of economic uncertainty.
And that's the thing, when you think about this period of economic uncertainty that we're living in, it's a much different scenario than we were in December 2018 when we saw that 35-day shutdown. Of course, then the Fed was leaning dovish or about to. Now you have a very hawkish Fed. What does that just mean for sentiment at the moment?
Yeah, we do think, normally in going into a shutdown, in a government shutdown, you don't really see a lot of market reaction. People realize that the government eventually has to reopen. But we do think just the environment that we're in today, coupled with the shutdown, has been adding to some of that volatility in the market. Our fixed income analyst, Tom Tsouras, has been talking about just not having economic data could put upward pressure on yields moving even higher in a period where, it's been very painful. So certainly not an ideal moment. I would say the other thing that's really concerning about going into a shutdown right now that's different than in 2018 is we already had Fitch downgrade the U.S.'s credit a couple of months ago off of the debt ceiling. And now you have Moody's talking about how a government shutdown and just the continuous issues of process for the fiscal state of the U.S. could lead to credit problems.
I'm glad you brought up Fitch, because, there were a lot of people that kind of derided that. They kind of said, oh, you guys are kind of being presumptuous here. You're basically saying you're downgrading us based on kind of the future, the idea that, okay, there's just so much dysfunction and that creates a certain level of market risk, and ergo, then the rating should be lower here. I guess that would have seemed ridiculous if we actually passed the budget on time and moved on with things. But the fact that we're talking about this right now seems like they're right.
I mean, we've had continuous issues passing budgets on time in Washington. This is not a new thing. We don't necessarily think that Moody's would downgrade the U.S. off of a government shutdown. We think that the more likely scenario is a credit watch, just because a debt ceiling is very different than a government shutdown. We're not talking about the full faith and credit of the United States. We're talking about a lapse in funding, very different levels of seriousness. But it is certainly, the S&P 500 for the year peaked July 31st, and we got downgraded August 1st.
And I know these are two distinct issues between the debt ceiling and a shutdown, but the underlying concern here is the dysfunction in Washington. And you mentioned how we've had these battles before. It's been going on now for over a decade now. We have not had, and we should point out, last time I checked, this was written into the Constitution. They're supposed to do this every year, and they have not done it every year for over a decade.
Yeah, it's a continuous issue, and I think what you have right now, you have narrow majorities that makes it really difficult to do anything, but especially in the current environment where you have, serious concerns about the U.S. fiscal state. Our net interest costs over 14% of tax revenues. Historically, that's been a trigger for either tax increases or austerity, concerns about the long-term debt, concerns about Social Security. So there are serious concerns that policymakers have about the future of government funding and our fiscal stability, and they're having those concerns. I would say it's better to have those on a government shutdown than on the debt ceiling, but certainly this is not invoking confidence.
And Courtney, let's enter into hypothetical land where potentially all three of the rating agencies had downgraded the U.S. Does that have any material impact, really, for how the U.S. is perceived in the bond markets and worldwide?
I certainly don't think it helps. We're going to have upward pressure on yields. There's going to be a continuous kind of questioning of the U.S.'s global standing. And you have this happening at a time where already, again, our fiscal state is not going in the right direction. So we're already having interest costs starting to squeeze out other government spending, and that's only going to be exaggerated if we have additional downgrades of the U.S. credit.
All right, Courtney, really great to catch up with you. Appreciate your time. That is Courtney Rosenberger-Gelman of Strategas Securities. And of course, even without Trump on the Republican debate stage last night, one person was clearly taking a page from the former president's playbook. We're talking about Vivek Ramaswamy, and it was really interesting. There was an interesting piece from our own Max Chafkin, who basically advanced the argument that Vivek Ramaswamy here is probably running for something other than president, probably aiming for a cabinet spot. We'll see.
Yeah, I guess. I mean, because he's not going to be president, at least based on the polling. But I do think it's interesting here how much he's risen up. I mean, he's still, I think, trailing DeSantis, but he's more or less, like number 3, right? I mean, it's Trump. And we should point out, Trump is so far ahead of everyone else. Yeah. This is almost a non-contest. But he's certainly in the mix.
I believe when you combine all of the others' numbers combined, it still doesn't match up to Trump.
But it's interesting you bring that up, because when people say, they say of all the people on the stage right now, the viable Republican candidates, he's probably most Trump-like, at least in terms of how he presents himself.
We'll see. I mean, I believe it was Trump who said that these are all job candidates. They're all running for jobs in the Trump administration should Trump win the overall election. I think he also said that he didn't see any vice presidents on the stage, so who knows?
Ouch. Did Vivek know that? Rhymes with cake?
I don't know. Vivek like cake.
Now, does he have a real job, like a day job, or is he just running for president?
He's co-founded Strive Asset Management.
Oh, yeah, that's a pretty big company, right?
Yeah, over
that's
$1
like
billion.
anti-woke, like agenda stuff?
Stuff like that, yeah. They have ETFs.
Okay, that's cool.
Yeah.
What else?
I mean, they have over $1 billion in AUM.
So what cabinet would he run? Because I thought he wanted to get rid of like 90% of the government or something. Would there be any cabinets left if he got elected?
I don't know. You should ask. I don't know.
I mean, he's more than welcome to come on the program. I mean, I don't think he can handle my interview, but he could go on and bring, and I'm sure, Katie, you'll talk to him, right?
I don't know. In any case, still ahead on the close.
All right. That ends our politics coverage here on the day here. Stick with us. We're going to set you up for what to watch in markets tomorrow. This is Bloomberg. Here's a setup for markets on Friday. A look at Eurozone's EPI in the morning.
Yeah, it'll be interesting to check in on that. And then we get some U.S. data as well. We're talking about U.S. personal income and spending and PCE. I'm very excited to see.
Also, those Michigan sentiment numbers could be interesting as well. It could also be interesting what we hear out of the UAW. Sean Fain's scheduled to give an update at 10 a.m. New York time tomorrow as to whether they're going to expand their strikes.
And we'll see what happens, of course, that expansion and what that means for the Michigan economy. And then we also have earnings actually before the bell. Carnival, one of the best performing stocks this year.
Carnival earnings, they really do never end. Now I'm getting tired of earnings.
Yeah.
And of course, we'll be on watch here for the government shutdown, see whether there's any progress on negotiations. Remember, they have to come up with the deal before the end of the quarter, which of course is this weekend. If not, then a lot of things will stop functioning as they intended to do. Balance of Power up next. Katie Greifeld and I will be back tomorrow. Thanks for watching us. This is Bloomberg.